let's get started. So friends, as you can see, we are given a loan account A1, okay, with balance outstanding of 3,75,040 rupees. As you can see, security available is 1,85,000, and the system classify NPA on 30th September 2019. It become NPA on 30th September 2019. So the question is, for loan account A1, we have to find that on 31st March 2021, right, under which category this account will fall and what provision is required, right? So these are the options that we have. Please check the option: substandard, D1, D2, loss asset. So friends, first of all, basics. So let me clear the basics of NPA category here. You know it very well. First 12 months after an account become NPA. So suppose this account become NPA here. So first 12 months it remains substandard. In this region it remains substandard. After that it moves to D1 up to 1 year. It remains D1. From 1 year to 3 year, right? From up to 1 year, from 1 to 3 year, okay, it remains D2. And from after more than 3 year, it will become D3. And if the loan is completely hopeless and nothing can be recovered, it become loss, right? Now let's look at where A1 fall. Now you can think of like it has become NPA since 30 September 2019. Okay. Now by 30 September 2020, by 30 September 2020, right? It has already completed 1 year as NPA. So it moved from substandard to doubtful. Now on 31st March 2021, it is still within the first year of doubtful, that is D1. So the category is D1. So this way you have to think. So first question answer is there, D1, yes. So the category is D1. Now the second part is provisioning. So what is the rule regarding provisioning? So it is normal provisioning, right? So substandard, remember 15% normally, and if it is doubtful asset, remember doubtful asset, different provisioning for secure portion and unsecured portion. So here I write secured and here I write unsecured, right? So what is the provisioning for secured portion? So 1525. Sorry, just wait a minute. Let me erase it. There is a trick also to remember it. If you want me to share the trick, you can join our Telegram channel. Link is provided in the description section. I have shared the separate trick video to remember the provisioning. So secure D1 provisioning is 25%. Secure D2 provisioning is 40%. Secure D3 provisioning is 100%. On unsecured portion 100%. Right. So now let's apply this concept. So on unsecured portion it is always 100% in both the three cases. Now let's apply this concept to this particular A1 category. Now you can see in the A1 category list how much is the loan outstanding. Here I am writing. So loan outstanding is 3,75,040. And how much security is available? So security available is 1,85,000. So this means secured portion is 1,85,000. How much is the unsecured portion? Very simple. 3,75,040 minus 1,85,000. So this will give us how much? 1,90,040. Right. So now let's calculate the provisioning separately on the secured portion and unsecured portion. So let's look at the secured portion first. How much is the provisioning for secured portion? I already told you for D1 category it is 25%. So calculate 25% of 1,85,000. How much would that be? So that will be 46,250. Now let's compute the provisioning on the unsecured portion. Very simple. Percent on the unsecured portion. So it is very simple to think about it. So 100% of what? 100% of 1,90,040. So that will be how much? 1,90,040. So total provisioning is how much? Total provisioning is, you can think easily, 46,250 plus 1,90,040. Sorry, 1,90,040. So that would be 2,36,290. Right. This is the total provisioning. So now account A1 is in D1 category and total provisioning is 2,36,290. So the correct option is option number B. So what we learned from this discussion is that, substandard means up to 12 months. After that D1, D2, D3 depending on the time. And provisioning is the higher for the unsecured portion, lower percentage for secured portion depending on category. For this case, D1 is 25% on secured. D1 is 25% on secured and 100% on unsecured. Just now we have discussed. Right. Now friends, on the same data, one more question is asked. Let's have a look. So the question is asking you that we are told that this account belong to micro. So now let's look at A2 account, right? So let's look at the A2 account. So this one is the A2. Now the question is A2 belongs to, micro enterprise. It has a CGT MSE guarantee of 75%. So you can see, so that is the peculiarity of the question. You will be able to get every type of, get exposure to every type of question that is possible based on provisioning. And in the examination, 5 marks case study were there based on provisioning. So, the question is CGT MSE guarantee, they have given 75%. Now let's see which category this fall and how much provisioning we require. So we have to tell the same thing, how much provisioning is required and which category it fall. That is all the question is all about. Now recall the timeline of NPA. First 12 months substandard. This then move to doubtful. D1 up to 1 year. D2 up to 1 to 3 year. D3 more than 3 year. Now let's look at account number 2. So let's look at A2. You can see easily that date of classification of NPA is 30 June 2018. Right. So now think about it. 30 June 2018. You can think like this. So 30 June 2018 up to June 19. So June 19, it remains substandard. It remains substandard, right? So for 1 year, it remains substandard. And till June 20, it remain in D1. Now the question is asking which time? Let's have a look. So the question is asking you, basically, yes, 13 June 2022. So the question is asking you 13 June 2022. Okay. Now tell me on 30th June 2022, it will be in which category? So it will be in D2, right? It will be in D2. So the account is in D2 category. I hope this makes sense to you. So A2 account till 30th June 2022 is in D2 category. Now, after that provisioning is being asked, how much provisioning to be made? So let's do the calculation here. Calculation of provisioning for this loan A2 in the D2 category. Let's go through step by step calculation. So first of all, outstanding versus secured. Let's look at the data. How much is outstanding? How much is secured? Let's look at the data. So the first thing is loan outstanding. How much is the loan outstanding A2? You can see 8,40,000. So let's write down 8,40,000 is the outstanding amount. How much is the security available? Security available is 3,27,000. So 3,27,000 is the security available. Okay. Now friends, that means how much is the unsecured? So if you talk about the unsecured portion, it is a difference. 8,14,000 minus 3,27,000. That would be 5,13,000. So this much is the unsecured portion. Right? Is it clear? 5,13,000 is the unsecured portion. Now friends, basically CGT MSE guarantee. Since this is a micro enterprise, so 75% of the unsecured portion, 75% of the unsecured portion is guaranteed by CGT MSE. So think of it like insurance. If the borrower does not pay, CGT MSE will pay the bank for 75% of that part. So out of 5,13,000 unsecured, how much is the 75%? So 3,84,600 is 75%. Right. So now how much is the remaining unsecured? How much is the remaining unsecured? So remaining unsecured is, you can think like this, 5,13,000 minus 3,84,600. That would be how much? 1,28,400. Right. So this is the unsecured portion. Now you apply provisioning norm for D2. Right. So you apply provisioning norm on the both. So first of all, on the secured portion, how much is the secured portion? You can see the secured portion is 3,27,000. This one was the secured 3,27,000. So 3,27,000 secured portion. How much is the provisioning? 40% D2. I think you know it. And on the unsecured portion, how much is the unsecured portion? 1,28,400. 1,28,400. Total provisioning is 100%. So what is 40% of 3,27,000? It is nothing but 1,30,800. And what is 100% of 1,28,400? It is nothing but 1,28,400. So if you add both of them, so let's add 1,30,800 plus 1,28,400. This would give us 2,59,200. So that is the total provisioning amount. So the final answer is 2,59,200. Let's look at the answer. Yes, 2,59,200. So what we learned from this discussion is that an account remains substandard for 12 months after becoming NPA. It becomes D2, D3, D2 and D1, D2 and D3 for next subsequent 1 year 1 to 3 year and more than 3 year, right? And I told you for doubtful provisioning is just very simple. Some secured 25%, secured D2 it is 40%, and secured D3 100%, and unsecured for D1, D2, D3 always 100%. And one more point is that for micro and small unit, CGTMSE guarantee reduces the unsecured burden. So always deduct guarantee cover before calculating the provision. So friends, that's the beauty of this question. And if you want such kind of question for practice purpose, you can WhatsApp me on this particular number, because we have full set of question available based on the past year memory based question. And this will surely help in the upcoming examination, as it has been helpful to the aspirant. Many aspirants have cracked the examination using our CCP resource, which is available on our app. App name is JIB and CIB Made Simple. So you can also get access to this premium content. Now friends, let's look at the third question. Very good question based on DP calculation. So the question is like this. Let's solve this cash credit DP question. Sanction limit is 500 lakh, which is equivalent to 5 crore. Margin on stock is 25%. Margin on book debt is 30%. Closing stock is 4 crore or 400 lakh. Credit for purchase is they have given 100 lakh. Book debt they have given 300 lakh. Question is asking for the DP for the day. Options are in front of your screen. So first of all, let's understand the basic. I already told you, I will clear every concept. Even if you don't know the basic of DP, let me clear it. So DP means drawing power. It is actual amount. It is basically actual amount a borrower can you withdraw. So actual amount that borrower can withdraw based on the available security after applying the margin, right? So basically when I say DP, it means actual amount that a borrower can withdraw based on available security after applying the margin. Now you may think that what is the meaning of margin? You might think, what is the meaning of margin? Margin means, bank is saying that we won't fund 100% of your stock or debtor. You must also bring some share. We won't fund 100% of your stock or debtor, right? You must also buy some share. So what is the meaning of DP? DP is the value of security available to the bank. Try to understand. Very, very important. Value of security available to bank minus margin, right? So DP is the actual amount a borrower can withdraw based on the available security after applying a margin. Margin means bank say that you must bring, I won't fund you 100% of your stock or debtor. You must bring some share, right? So max actual amount the borrower can withdraw based on the available security. Now for calculating DP, there are some steps which has to be followed. First of all, you have to calculate the paid stock. What is the meaning of paid stock? See, total stock, from total stock we remove the creditor because that portion is not financed by the borrower. Yes. So paid stock means from the total stock is how much? Total stock is 400 lakh. This is the total stock. And from that we subtract the creditor. Because creditor means udhar. Because this amount will not be financed by the borrower. That person is not financed by the borrower. So how much we subtract? 400 minus 100. So 400 minus 100 will give us how much? That will give us 300 lakh. Okay. Now that is what we have calculated the paid stock. Second thing we will do, we calculate the bank value of stock. So before that we need to calculate the margin. So margin is how much? Let's look. So margin is 25% on a stock. You can clearly see. So margin is 25%. Okay. So bank take only 75%. So the bank value of a stock will be 75% of 300 lakh. That would give us 225 lakh. Now that is the bank value of a stock. What is the bank value of book debt? So book debt means receivable. Receivable means what? Receivable means some amount which is still left to be collected from the customer. So on that, that is applicable. Bank will finance that. But creditor will not be financed by the bank. So book value of the bank value of the book receivable will be how much? Very simple. You can see 300 lakh book debt is there. And as per the rule I told you that margin has to be applied 30%. On book debt 30% margin to be applied. More margin is there on book debt. So 30% of 300 lakh would be how much? I think it is 90 lakh. So subtract that. So the bank value will be 300 minus 90, which would be 200 lakh. So that is the bank value of book debt. Now you add then. So from stock we have 225 lakh. From book debt we have 210 lakh. After addition they would give us 435 lakh. Now let's check the sanction. How much is the sanction amount? Sanction amount is 500 lakh. And DP we have calculated is 435 lakh. So bank allow the lower of the two, either the sanction amount or the DP amount. Bank will allow the lower of the two. So obviously bank will allow 435 lakh. So 4.34 crore is the correct answer. So this is how we should go about solving such kind of problem. Remember, such question was asked in the recently held CCP examination. So why other are wrong? 500 lakh is wrong. This is just the sanction limit. 300 lakh is wrong because only paid up stock margin not calculated. So from this discussion, what we come to know, let's just summarize the key point for your understanding purpose. So remember, whenever question asks you to compute DP, whenever try to understand this concept, whenever question asks you to compute DP, so remember DP is the minimum of sanction amount or eligible amount. This is the formula, right? So for a stock, suppose it is a stock, so you should subtract the creditor. You should subtract the creditor and then apply margin. And if it is book debt, so you should apply margin directly, right? And add both of them to get final DP. I hope this makes sense to you. Now let's have a next question. So friends, basically the question is, which of the given statements are true about the exposure limit and the connected counterparty? So basically, why do RBI create this rule? To avoid concentration risk. Yes, the basic purpose is to avoid the concentration risk. That means banks should not put too many eggs in one basket. Right? If a single borrower or a group of borrowers fail, the whole bank should not collapse. That is the main role of this particular, concentration risk. So RBI fixes limit based on the bank tier 1 capital. Based on the bank tier 1 capital, RBI fixes the limit. Right? Now the question is, how much is the limit? Very, very important concept. Let's discuss it. So options are given like, exposure ceiling for a single counterparty is 20% of the bank tier 1 capital with an additional 5% allowed. B option says that exposure to a group of connected counterparties is capped as 25% of tier 1 capital. C says that 2 or more persons are considered a group of connected counterparty if there is either control relationship. D says that economic interdependency implies that financial trouble of one counterparty is likely to cause difficulty for other in meeting obligation. And E say all of the above. So very important conceptual question. So remember the limits. What are the limits? Let's have a look. So limits are like this. For a single borrower or single counterparty, maximum exposure is 20% of tier 1 capital for single borrower. In a special case, with board approval, it can go up to 25%. So remember, for a single borrower, maximum exposure is 20% of tier 1 capital. And in a special case, it can go up to 25%. For a group of connected borrower, connected counterparty, like related or contingent, in that case, limit is 25% of tier 1 capital. For group of connected party, it is 25% of tier 1 capital. Now the question is, what is the meaning of this connected counterparty? See, there are two tests. One test is called control test. What is control test? It says that if one person or if one company controls the other, like a parent subsidiary relationship, that is called connected counterparty. And the second test is called economic interdependence. Economic interdependence, which means, even if there is no control, if one party financial problem can create problem for another, they are called connected. For example, suppose company A is the only buyer of company B goods. So if A goes bankrupt, B will also struggle. That is called economic interdependence. So now think about it. Which option do you think is correct? So obviously option number A is also correct because it says 20% for bank tier 1 capital with an additional provision of 5%. Yes, 25% is there for, So remember the limit. So the answer to this question is option number E, all of the above. Now friends, the next question is on your screen. Very good question it is. This question pertains to PMEGP scheme. PMEGP is the Prime Minister Employment Generation Program. The question asks, what is the maximum turnaround time, we call it TAT, for the disposing loan application under this scheme? Right, above 5 lakh and up to 5 lakh. So let's understand the basic of PMEGP. Basically PMEGP is a government scheme to support people who want to start micro and small enterprise. So people who want to start micro and small enterprise, for them, PMEGP scheme is there. Now, since it is meant to help a small business quickly, the government has also a clear timeline for bank to process application. So what is the guideline for TAT or turnaround time? See, if the loan amount is less than 5 lakh, okay, so bank must decide within 15 days. It must be decided within 15 days. And suppose the loan amount is above 5 lakh, in that case, decision must be given within 30 days. So the idea is simple. A smaller loan should be processed faster because a small entrepreneur need fund urgently. Now let's look at the option. Option A say 30 day for loan above 5 lakh, 15 day for loan up to 5 lakh. Yes, it is correct. Option B say 15 day for all the loan amount. No, that is wrong. C say 45 day and 30 days. Again wrong. D say no specific TAT, it again wrong. So remember, PMEGP help promote micro and small enterprise. And if we talk about the loan disposal timeline, it is very simple. The loan disposal timeline is very simple, right? So it says that up to 5 lakh, it is 15 days. Remember, 15 days up to 5 lakh, right? And above 5 lakh, it is 30 days, right? So that is the timeline. And you know it very well. Faster processing means quicker support for entrepreneur. So if processing is faster, it means, quicker support. That is the basic thing, right? So the correct answer to this question is option number A. Now friends, let's look at the next question that we have. So this one was regarding the PMEGP scheme. So this question is pertaining to willful defaulter as per the RBI guideline. So the question say, which of the following situation may result in a company being classified like a willful defaulter? Options are, the company has defaulted on loan repayment even though it has ability to pay. Option B, the company has used fund from the bank for processes other than what they were sanctioned for. Option C, company has siphoned off the fund so they are neither used for the intended purpose nor are available as asset. Option D, company has disposed of or removed asset placed as security for the loan. And option E, all of the above. So first of all, let's try to understand what is normal default. What is normal default? So normal default means borrower is genuinely unable to pay because of financial stress. Genuinely he is unable to pay. And what is willful default? So when I say willful default, it means borrower can pay but chooses not to pay. Or misuse the bank money. So willful default is all about intention and misuse. It's all about intention. It's all about misuse. Right. Now friends, let's look at this situation under RBI definition. So the first thing is that default despite ability to pay. This is the first case. Right. Default despite ability. So which means, the company has enough money but does not repay. That is the case of willful default. Second case is diversion of fund. You know what is the meaning of diversion of fund? It simply means that, using bank loan for something else. For example, loan taken for factory setup but money used to buy luxury car. And the third thing is called siphoning of fund. Please remember these three criteria. All these three comes under willful default. What is the meaning of siphoning of fund? So it means money is taken out in such a way that it is neither used for the project nor available as an asset. For example, suppose you took the loan taken, but funds secretly transferred abroad. And the fourth case is disposal of secured asset. Very, very important. Disposal of secured asset. So what it means, selling or removing asset placed to the bank without informing. Like machinery given as a collateral, but quietly sold off. So all these four cases clearly indicate, willful default. So these are the red flag. Now check the option. Option number A say defaulted with the ability to pay. Yes, this is the clear definition of, willful default. Option number B say, the company has used the fund from the bank for the purpose other than, this is called, diversion of fund. Yes, this is also another one case. C say company has siphoned off the funds, so never, okay, this is all siphoning. Yes, this is all the condition. And D say company has disposed of, remove of asset. Yes, this is also the condition. So E is the correct answer. Right. So remember, what we learned from this question is that, willful default means deliberate wrongdoing, not genuine inability. Four main reason I told you. First of all, not paying despite ability. B number I told you, diversion. C number I told you, siphoning. D number I told you, selling the asset or removing the secured asset. I hope that makes sense to you. Now friends, let's look at this very interesting question presented before you. The company reported an annual turnover of rupees 42 crore in the previous financial year. So the question is, how will this company be categorized under MSME norms? Right, micro, small, medium, not as MSME. Think about it. So based on the MSME classification, earlier MSME were based on investment in plant and machinery, but now they are classified based on turnover. So what is the rule? So it is very simple. Draw this timeline. Write down 5 crore. Write down 50 crore, and write down there 250 crore. See, very simple. Micro enterprise means turnover up to this, so turnover. So turnover up to 5 crore is micro. From 5 to 50 it is. So what do you think? Which option do you think is correct? So now in this case, turnover is given 42 crore. So it is more than 5 crore but less than 50 crore. So it falls in the small enterprise category. Right. So I think this is the very easy one. So you must know the criteria of turnover. You must know it, and you can easily answer this question. Okay. Now friends, let's look at the next question. So the next question says that as per the latest rule, what is the maximum number of partner allowed in a partnership firm in India? Right. Very, very important. So let's first understand what a partnership firm is. Partnership firm is simply a business where two or more people come together to run a business and to share the profit. But there must be a limit on how many people can join a partnership firm, right? So earlier the limit used to be 20 partner. Fine. And in the banking business, just 10 partner. Earlier the limit used to be 20 partner in general, and in the banking business, it used to be only 10 partner. But in 2014, what happened? That company rule, the government updated it. The latest rule says that maximum number of partner in a partnership firm can be 50. 50 is the maximum number of partner in the partnership firm. That means you can start a partnership with 2, 5, 10, even 49 people. But once you touch 51, you cannot remain a partnership. You will need to register as a company. So the answer to this question is 50. So remember, partnership firm is 2 or more person running a business together. Earlier limit was 20 or 10 for banking, but now the maximum per partner law is 50. Now the question is very good regarding the RBI Gold Card scheme, right? So friends, which of the following is to be eligible for the RBI Gold Card scheme? Exporter with a minimum 3-year track record, continuously classified as standard asset with no adverse future. B. Exporter blacklisted by the ECGC. C. Exporter have a loss of at last 3 years. D. Exporter on RBI defaulter list. So first let's understand what is this RBI Gold Card scheme. They think of it like a special membership card for exporter. If you are genuine and consistent exporter with a clean record, the bank give you faster and easier access to credit facility. Basically, it is like, being a priority customer for bank when it comes to export finance. Yes, you are a priority customer. Now let's look at the option one by one. Option number A says that exporter with at least 3 years of good track record with account always standard. Yes, this sound good, like a perfect candidate for the gold card export. What about B? See, B says exporter blacklisted by ECGC. You know what is ECGC? Export Credit Guarantee Corporation. So B number says that exporter blacklisted. Now option number B says that exporter blacklisted by ECGC. So yes, that is also correct. If you are on RBI defaulter list, right? So if you talk about the B, if you are blacklisted, obviously you won't be given a golden card, right? What about option C? Bank want healthy business, not one running in continuous loss. So option number C is also not eligible. What about D? D is the defaulter risk. So if you are an RBI default risk, it means you have already failed to repay the loan. Now, no way you will get the gold card. So option number D is also wrong, right? So that is the point. So continuous loss. Right answer is option number A. Now friends, let's look at the next question. Which of the following is not a benefit provided under the gold card scheme for exporter? Again, one question from gold card, right? So you can think of it like this. If you are a regular exporter who have a good track record, the bank give you a VIP pass. The VIP pass is called gold card. And just like any VIP card, it comes with some special benefit, like preference in granting packing credit and term loan in the foreign currency, loan sanction with an in principal limit valid for 3 years with automatically renewable, C says higher processing charge compared to other exporter. D say a standby credit limit of at least 20% of the assets limit for urgent credit requirement. So friends, first of all, option number A, benefit. Preference in loan. Yes, preference in loan, which means, that means if you need packing credit or a foreign currency loan, try to understand. If you need packing credit or if you need foreign currency loan, right? In that case, the bank will prioritize you. Basically, you don't have to wait in the long line. No need to wait in long line. That is the point. Second case is loan sanction for 3 years. Not just that, it comes with automatic renewal facility. Yes, automatic renewal facility is there. So exporter don't have to go through the headache of reapplying again and again. Option C, bank give you a standby credit limit. Yes, at least 20% extra than your assets limit. Why? Because sometimes exporter need urgent money and this standby limit work like an emergency fund. Yes, you get a standby limit. Yes, this is also one benefit. Right. What is the second benefit? Loan sanction for 3 years. But here is a trick part of the question. One option say higher processing charge. That is the wrong. Basically, now tell me, will a VIP pass holder ever be charged extra? Of course not. In fact, gold card exporter enjoy lower processing charge as compared to the others. That's why option number C is the correct answer. So remember, gold card is like a VIP pass for exporter with good track record. Benefit is that they get priority in loan, 3-year sanction with auto renewal, a standby credit of 20%. Charges are lower, not higher. I hope that makes sense to you. Now, one more question is that regarding the IRR. So let's tackle a very popular finance concept that is called internal rate of return. Don't worry if this sounds technical. I will explain it. Is super simple. Imagine this. You invested 10,000 rupees today in return in a project. In return, this project give you back 4,000 rupees after 1 year, 5,000 rupees after 2 years, 6,000 rupees after 3 years. Now the big question is this project profitable enough? So that is where IRR comes into picture. IRR is simply the rate of return at which the project net present value becomes zero. In plain English we say it is the interest rate at which money you put in equal to the money you get back in today's value. So the formula is 0 is equal to, so you calculate the present value of all these inflow. So you can think of like this. Today we have invested 10,000 rupees. Okay. And after 1 year, 4,000 you get as cash. After 2 years, 5,000. After 3 years, 6,000. You calculate what is the present value of this 4,000. How do you go about calculating it? So 4,000 divided by 1 plus r whole to the power n. Similarly, 5,000 divided by 1 plus r whole to, what is r? R here is, rate of interest. So what is the rate of interest? That is what we have to calculate. We don't know the IRR. Yes. And similarly 6,000. So here power will be 1, power will be 2 and 6,000 upon 1 plus r to the power 3. Right. And now, so that will give us the present value of all the cash flow. Let me write it down. So 4,000 upon 1 plus r plus 5,000 upon 1 plus r square plus 6,000 upon 1 plus r to the power 3. Now that is our present value of all this cash flow. And what we have to do? So these are, these are the positive cash flow that we are receiving. And how much is the negative cash flow? 10,000. So this is the net cash flow, net present value. And that has to be equated to 0. So where R is the IRR. How to find this R? So the best method is to put the value from the option. So first start with 15%. Just put R is equal to 15% and just see whether LHS is equal to RHS or not. This is the best way to calculate the IRR using the option. Using the option method is the best one. Otherwise, welcome to the channel JIB and CIB Made Simple. Today we are going to discuss IIBF CCP memory based question which were asked on 13th September examination. So basically these questions will help you see the kinds of question you can expect in the next examination. Obviously question will not repeat but concept will repeat. So whatever concept you will learn from this question will surely help you in the upcoming examination. So let's get started with our first question. Right. So basically the question is, this is a numerical question. You must have pen paper calculator with you. Right. And question is, the bank is sanctioning a housing loan of 60 lakh. So how much they are sanctioning? You can see they are sanctioning housing loan of 60 lakh. Margin requirement they have given 20%. Right. This is the margin applicable. Right. And RBI has prescribed L2 LTV cap. What is LTV? Loan to value caps. You know it. So considering both margin requirement and RBI LTV stipulation, which of the following is correct? So option number A says that bank can lend 48 lakh since margin of 20% applies on 60 lakh. Now let's check this. So friends, what is given here? Let me explain. So margin 20%, right? They have written clearly that margin is 20%. What does it mean? It means the borrower must contribute 20% from their own pocket, right? Borrower must contribute 20% from their own pocket. That is the meaning of saying margin is 20%. So the bank can finance the remaining, right? So bank will finance remaining 80%, right? Now you think about it. Total is 60 lakh, right? Total, total loan, housing loan is 60 lakh, right? So what is the 80% of 60 lakh? That will be financed by the bank. That would be 48 lakh. So this 48 lakh is, the bank finance. This look, now let's look at the option. So the bank can lend 48 lakhs, is margin of 20% apply on 60 lakh. So this look correct from the margin side. But wait, we also have to check the RBI LTV. We also have to check the loan to value ratio. So option A is half correct, only margin side, but RBI rule has not been mentioned. That's why it is incorrect. What about option B? It says that bank can lend 54 lakh as RBI allow maximum 90% LTV up to 30 lakh and margin take care of the rest. This sound tempting, but let's take carefully. What RBI says, RBI says that 90% LTV, right? RBI stipulate that, 90% LTV, it apply, right? Only for loan up to 30 lakh. So loan if up to 30 lakh, only then, 90% LTV will apply. But here, what is our loan amount? Our loan amount is 60 lakh. Clearly you can see. Let me show you. You have seen, right? Our loan amount is 60 lakh. So RBI says that if the loan amount is minimum less than 30 lakh, then 90% LTV will apply. But in this case, our loan amount is 60 lakh. So this fall in the slab of, there's a slab. It fall in the slab of 30 to 75 lakh. This slab it will fall. And for this slab, what is the LTV? Remember, let me write it down. So if it fall in 30 to 75 lakh slab, in that case, our LTV is how much? It is 80%, maximum 80%. This is the maximum that RBI can permit. So now 54 lakh. So here what is written 54 lakh? How much is the 54 lakh? It is the 90% of 60 lakh. So this is wrong. This is not allowed. That's why option number B is also wrong. Now option number C, have a look. Option number C is that bank can lend 48 lakh, but the sanction must also comply with RBI maximum 80% LTV norm applicable for this slab. Let's check this. So margin say 20% borrower contribution, right? What margin is saying? Margin is saying that 20% borrower contribution. That is what margin means, right? Margin means borrower contribution, which is 20%. If you find 20% of how much? 20% of, 60 lakh, that would give 48 lakh. So this 48 lakh is the bank finance. 48 lakh is the bank finance, right? So RBI say for 30 to 75 lakh loan, RBI says that for this range loan, right? What about the maximum LTV? Maximum LTV is also 80%, which is again 48 lakh. So now you see both the margin rule as well as the RBI LTV rule are both satisfied in the same value. That's why this is our correct option. Option number, let me show you. Yes, C is the correct answer, right? Because this both satisfy. Margin rule also satisfy, and LTV rule also satisfy. This is the perfectly correct answer. What about option D? Option D says that the bank can lend 45 lakh because above 75 lakh loan can attract 75% margin LTV and banks should follow them stricter norm. Careful here. Our loan amount is 60 lakh. That fall in the range of 30 to 75 lakh. This slab it fall. Not above 75 lakh. Right. So 75% rule does not apply here. Hence option number D is wrong. So final answer is option number C. So what is the learning from this question? Must see. First of all, we learned is that margin is the borrower contribution. Remember it. Margin is the borrower contribution. Right. So here 20% is the margin, which means bank can give maximum 48 lakh. Now you must know the RBI LTV rule. What is RBI LTV rule? It says that if loan amount is less than or equal to 30 lakh, right, in that case LTV will be 90%. If it lie between 30 to 75 lakh, then LTV maximum will be 80%. If it is above 75 lakh, then maximum LTV will be 75%. Just remember this LTV rule, super important. Maximum chance of repeating it in the upcoming examination. If you really think that this video is really helpful for your understanding, please hit that like button. So friends, remember, whenever you calculate housing loan limit, always check both margin requirement as well as RBI LTV cap. That way you will never get confused. Friends, if you are looking for study material for CCP, sure sort of study material which will helpful in the upcoming examination, you can clearly look out for our courses. In the description section of the video, you can check our CCP course. You can WhatsApp me on this particular number to get more detail regarding availing the course. 8292857381. Now friends, let's look at the question number 2. So now in this slide, we will talk about important MCQs on priority sector lending certificate. In short, we also call it, PSLC. Right? We call it PSLC. Priority lending lender certificate. Right? So the question is, which of the following statements are correct regarding the PSLC and bank loan to MFI? Option number A says that PSLC remain valid till 31st March and expire on April 1st. Option number B say that, bank can classify PSLC only if the underlying loan are eligible under the RBI priority sector norms. Option C say that bank can lend to registered NBFC MFI societies trust for on lending to individual SHG and JLG. Option number D say that PSLC may be issued for multiple quarter but expiry is still end of the financial year. Answer choices are A, B and C, B and D, A, B, C and D and A and C only. Very good question. Let's answer it. Let's look at option number A. Option number A is true. No matter when you buy the certificate, April, September, February, it will expire on 31st March. It will always expire on 31st March. No matter when you buy it. Right? Suppose a bank buy PSLC in January. They can use them only till March 31st. On April 1st, they are gone. Just like a movie ticket that expire after the show. What about option number B? Option number B, it says that bank classify PSLC under respective priority sector lending category. Right. Yes, this is also true. What we have seen, option number A is true. Question is asking which is not true. Not correct. Oh, okay, it's all correct. Option number B is also true. Because, PSLC are like, right to count. You can call them right to count. What does it mean, Basically, these are like, right to count another bank loan as your own priority loan. But if the underlying loan is not genuinely priority sector as per RBI, then buying a certificate will not help. Let me give you one example to make it more clear. Let's suppose that, if a PSLC is issued against a car loan, suppose again car loan, we have issued a PSLC certificate, right, for a luxury car. That won't qualify. Only loan eligible under PSL norms will count. That is called the count rule, right? Right to count. Now, option number C. Bank are permitted to lend to registered NBFC MFI society trust that are member of the RBI recognized SRO for on lending to individual and JLG SHG. This is true. This is correct. Why? Because RBI allow bank to support MFI. You know what is the meaning of MFI? Microfinance institution, right? Because lending to a small borrower, self-help group and joint liability, right? Because they lend to these kinds of category, right? So for example, suppose a bank give money to an MFI. Let me give you one example. This is the bank and what it give? It give money to MFI, right? And MFI uses it to give 20,000 loan to women SHG, right, in the village. So this indirectly fulfill the bank in the PSL target. Yes, that's why option number C is also correct. What about D? D says that PSL can be issued for multiple quarter, but their expiry will still be the end of the financial year. Again true. You may have PSLC transaction in quarter 1, quarter 2, quarter 3, quarter 4, but expiry does not depend on quarter. It is fixed on 31st March. Right. So friends, what we have seen that all options are correct. Right. So third number is the correct one. So what we have learned from this discussion is that, let me summarize. I told you, first point is regarding the PSLC validity. So remember, it is always ending on March 31st. Remember it. Second point I told you is regarding the, a classification. So, classification only if underlying loan are PSL eligible, right? Then we talk about loan to MFI or on lending to MFI. So always on lending is allowed if NBFC MFI, society, trust are RBI recognized through SRO. So if this NBFC MFI, society, trust they are RBI recognized through the SRO. SRO means self-regulatory organization. Then they are eligible. And multiple quarter. Yes, this is another point. This is called multiple quarter. Multiple quarter means possible, but expiry is fixed at the financial year. So friends, the key takeaway is that PSLC are valid only till the end of the financial year, and bank must always ensure that PSL eligibility of underlying loan. Also, lending to MFI is encouraged to meet the PSL target. I hope this answered your question. Now friends, let's look at one more important topic. Which of the following statement regarding the creditor turnover ratio is or are correct? Very good question. So friends, options are: a high ratio indicate that the company is prompt in paying supplier, reflecting a strong credit worthiness. Option B, a low ratio may indicate delayed payment, but can also occur if the company enjoyed longer credit period allowed by the supplier. For calculating the ratio, only credit purchase are considered as numerator. If credit purchase is missing, total net purchase can be used. Option D, average account payable is calculated as the average of opening and closing balance of the account payable. If opening balance is unavailable, then closing balance can be used. Very good question. Question is, which of the following is or are correct? Let's look at option number A. Option number A, yes, it is correct. Because this ratio tells us how many times in a year a company clear its dues to the supplier. That is what creditor turnover ratio. Means what is the meaning of it? Let's try to understand. Suppose you have a company, you have a firm, and you have taken you have availed some goods, you have availed some kind of services on credit. You have not paid yet. So basically you have to clear your dues. So how many times a year you are able to clear your dues? That is what this creditor turnover ratio is all about. If the ratio is higher, it means company pay quickly and multiple times in a year. Right, simply you can think. So question may be asked in the form of numerical, but if you know the logic, you can easily answer it. Right. So if the creditor turnover ratio is higher, what does it mean? Company pays its dues very quickly, and since it pays its dues very quickly, multiple time in a year. So let me give you one example to learn it. Suppose there is a shop, and that pays its supplier every month, right? So that is the 12 time in a year, right? 12 time in a year. So it is a high ratio. So supplier trusts this shop. So yes, option number A is correct, reflecting the stronger credit worthiness. What about B? It says that a lower ratio may indicate delayed payment. Yes, this is also true. When the creditor turnover ratio is lower, it looks like a negative sign because it suggests slow payment. Yes, it's a negative sign because it suggests the slow payment, right? But sometimes, it simply means supplier have given the company longer time to pay, say 90 days instead of 30 days. So a big retail chain might negotiate longer payment term with supplier. So ratio look low, but it's not a problem. It's not always a problem. It indicates delayed payment, but it can also occur if the company enjoy longer credit period. Yes, supplier has given longer credit period, then it can also occur. What about C? For calculating the ratio, only credit purchase are taken in denominator. See, this is also true. If you talk about the formula of the account turnover ratio, creditor turnover ratio or account payable turnover. So what is the formula? Very simple, right? You write the net credit purchase in the numerator, right? In the denominator, you write the average account payable, right? Now the question is, why only credit purchase? Because payable means money owed to the supplier, and the cash purchase don't create payable, right? That's why only credit purchase. But if the company does not give a credit breakup, then we have to use total purchase as a substitute. Now what about option D? Option number D says that average of the opening balance and yes, A, B, C, D all are correct. So what we learned regarding the credit turnover ratio or account, or you also call it account payable turnover. So remember, if this ratio is higher, so high ratio, what it means? Fast payment. High ratio means fast payment, which indicates good credit image. It gives you good credit image. And if the ratio is low ratio means delayed payment. Low ratio means delayed payment or long supplier credit, right? Then I told you the formula for account payable turnover. In the numerator, you write the credit purchase. In the numerator, you write the credit purchase. In the denominator, you write the average account payable, right? Average account payable. The credit purchase upon average account payable, that gives you account payable turnover. or credit turnover ratio. And sometimes account payable, if you want to find it, so you write the opening balance plus closing balance divided by 2. Means at the beginning of the year, how much was your balance? At the end of the year, how much is the balance? Divided by 2. That will give you average account payable. Therefore, all the 4 statements are correct. So friends, remember, this ratio basically shows that how disciplined a company is in paying its supplier, right? How disciplined a company is paying supplier. High ratio means quick payment. Low ratio could mean delayed or simply longer credit term. I hope you like this explanation. Now friends, let's look at the next question. So question number 3 of today's session is on your screen. As you can see. Yes, the question is regarding the CRILC. Very, very important question. It asks you that which of the following statement about CRILC and SMA categorization is or are correct. Option number A, that bank must report to CRILC all credit information of borrower with aggregate fund limit and non-fund based exposure of 5 crore and above. Means reporting of borrower 5 crore and above. Option number B talk about crop loan exemption. So says that crop loan are exempted from CRILC reporting, but other agriculture loan must still be reported. Option C says that interbank loan are not reported, right? Like NABARD, SIDBI, Exim Bank, NHB, they are not required to be reported. And option number D says that SMA 0, right? SMA 0, 1, 2 classification, right? SMA 0 refers to account not overdue beyond 30 days. SMA 1, 31 to 60 days. SMA 2, 60 to 90 days. And option number E says that failure to report SMA status or concealment of actual account stress may lead RBI to impose accelerated provisioning or other supervisory action. Very good question. Let's look at option by option. First of all, option number A. Right, let's have a look. So basically, this option number A is true. Why? Because, if you talk about the CRILC, it's like a database. It's like a database at RBI where banks share details of large borrower. Right. If one borrower take loan from multiple banks, so CRILC, this act like a database. You can think of it like a database. Okay. And suppose this is a one borrower, right? Suppose this one borrower has taken loan from multiple banks. This is bank number 1, this is bank number 2, this is bank number 3. In that case, what will happen? This CRILC will help RBI, right? And bank see the total exposure. Bank always see the total exposure. Just remember it. Let me give you some example. Suppose a company has 6 crore loan, right? It is spread across 3 banks. Suppose 2 crore here, 1 crore here, and 3 crore here, right? So what the rule says that all bank must report it to CRILC. Every bank has to report to the CRILC, right? That's why option A is correct. What it says that bank must report to CRILC all credit information of borrower with aggregate fund base of 5 crore and above. Option number B says that crop loan are exempted from CRILC reporting. Yes, this is also correct. Why? Because crop loans are seasonal and short term. RBI keep them out to avoid unnecessary reporting load. So, the reason behind it. The reason is very simple. The crop loan are, seasonal. Crop loans are, seasonal. And also they are short term. Right. So RBI keep them out to avoid unnecessary reporting load. But if it is another type of agriculture loan, like tractor loan, warehouse loan, it must be reported. Suppose it is agriculture loan, like tractor loan or warehouse loan, it must be reported. But crop loan need not to be reported under the CRILC, whatever be the amount. Now option C, that exposure like interbank loan, right, including to NABARD, SIDBI, Exim, right, SIDBI, Exim Bank, they are not reported to CRILC. That is option number C. This is also correct, right? Because these are called interbank loan. Interbank loan are more of institutional arrangement. Remember, these interbank loan, they are more of institutional arrangement. These interbank loan, they are more of institutional arrangement, right? Not customer level risk. They are not customer level risk. So if a bank A lend to NABARD, that does not go to CRILC. Very, very important part I'm telling you. That suppose there is a bank A and this bank A, it lend to NABARD. Bank A lend to NABARD. It will not go to the CRILC. So C is correct. C is also correct. What about D? D says that SMA 0. So SMA categorization. Yes, this is exactly how it works. Let's have a look. So if we talk about the SMA categorization, yes, you can see it here. So SMA 0 means account not yet overdue but showing stress, like check bounce, stock statement delays, right? Then SMA 1 means overdue for 31 to 60 days. SMA 2 overdue for 61 to 90 days, right? For example, let's take one example. Suppose there is a borrower, right, who misses payment by 45 days. He misses payment by 45 days. So as per the rule, it will be covered under SMA 1, right? And if the delay is 75 days, which lie in 60 to 90 days, then it will be under SMA 2. So D is correct. If you look at the option number D, yes, it is correct. What about E? E says that failure to report SMA status or concealment of actual account stress may lead to RBI to impose accelerated provisioning. Yes, that is also true. You see the condition for imposing the accelerated provisioning. RBI is very strict. If a bank try to hide a stress account or to make it book look goods, RBI can force higher provisioning or other penalty. So we can see that all the options are correct. A, B, C, D and E, all are correct. So what we learned from this discussion is that, first of all, I told you about CRILC reporting. Exposure above 5 crore and above. Just remember this point. Exposure above 5 crore and above or 50 million and above. Right. Then I told you about crop loan. Crop loan are exempted, but other agri loan must be reported. Then I told you about, basically, I told you about interbank exposure. Remember it, interbank exposure? So they are not required. Interbank exposure, they are not required to be reporting to CRILC. And SMA 0, no overdue. But not overdue, means overdue less than 30 days. SMA 1, 31 to 60 days. SMA 2, overdue between 61 to 90 days. And I told you that, supervising action, that RBI can impose penalty and accelerated provisioning. So friends, remember, CRILC is RBI watchdog for big borrower. And SMA tagging is an early warning system for NPA. I hope you understood this background. Don't forget to hit the like button. This will motivate me to make more such content. Now friends, have a look at the next question that we have. So now we will discuss a very important MCQs on adjudicating authority under the Insolvency and Bankruptcy Code, commonly called IBC. We will check each option one by one, understand in simple word, and then pick the correct answer. So the question is, which of the following statement regarding the AA? You know what is AA? Adjudicating authority under the IBC are correct. Option number A. NCLT act like a AA for insolvency and bankruptcy procedure of the corporate and LLP. Option B. DRT act like a AA for insolvency, resolution and bankruptcy of individual. Option C. Appeal against DRT order, that is the part 3 of the IBC. It goes to the DRT. Option D. Appeal from NCLT order go directly to the DRT. Very good question. These are the 4 options that we have. Let's look at option number A. So option number A, it is true. Yes, option number A is quite true. Why it is true? Let me give you the reason. Because NCLT, it handle insolvency for companies and LLP. Yes, right. Like suppose a big company like ABC Limited default, then insolvency case goes to the NCLT. So yes, it is the correct one. What about option B? If you look at the option B, this is also correct. Because DRT or Debt Recovery Tribunal, they look after small entities like individual or partnership. Right. So suppose if a small partnership or business or an individual default, then the case go to DRT, not NCLT. Option C. Appeal against the order of DRT will be filed before the DRT. Yeah, this is also true. DRT stands for Debt Recovery Appellate Tribunal. It is the highest authority of DRT. So if someone is unhappy with DRT decision under IBC, they can appeal to DRT. What about option D? Option D is wrong. Because here we are talking about the corporate case. Right. Here we are talking about the corporate case. So just remember, if you talk about the corporate case, NCLT is the first stage. What is the first stage? First stage is the NCLT. First stage is the NCLT. Appeal goes to NCLT, not DRT. Appeal goes to the NCLT, that is the National Company Law Appellate Tribunal, not DRT. For example, if NCLT passes an order against a company, the appeal cannot go to DRT. It must go to NCLT. So option D is incorrect. Right. So what is the correct answer? A, B and C. Yes, this is the correct one. A, B and C is the correct one. So let's quickly summarize the key point which we have just covered here. So we started with NCLT. I told you that NCLT, the key takeaway is that, corporate goes to NCLT, individual goes to DRT, and also appeal from NCLT goes to NCLT. while the appeal from DRT goes to DRT. You can think of it like this. Suppose this is the corporate and this is the individual. So corporate goes to NCLT, individual goes to DRT, appeal goes to NCLT, and appeal from here goes to the DRT. Right? I hope you like this clear explanation. Now let's do one numerical based question based on it. Let's do one numerical based question. Now very good question it is, and this question was recently appeared in the examination. Let's have a look. So the question says that the borrower has an outstanding loan of 50 lakh, right, and a security worth 20 lakh. The loan is partially covered under CGTMSE for 75% of the unsecured portion. And they are also saying that account has slipped under the D1 category. What is the meaning of D1? D1 means doubtful one, right? Account has slipped under the D1 category or doubtful one category. So question is, as per the provisioning norm, how much provision should the bank create? So very good question it is. So options are 10 lakh, 12.5 lakh, 15 lakh and 20 lakh. So now let's see the step-by-step explanation here. Right. I request you to please pause the video first and first try it yourself. Very, very important thing I'm telling you. If you don't try, then you will not be able to understand the pre-concept. If you do mistake, then you can easily remember it. Right. So outstanding loan 50 lakh, collateral is 20 lakh, CGTMSE covers 75%, D1 category. This data have been given. Now, first of all, let me show you the data. What they have given? They have given outstanding loan. How much? 50 lakh. Okay. So this is the total amount that borrower owes. Then we have the secured portion. How much is the secured portion? 20 lakh. Because collateral worth 20 lakh is available. Now, D1 category. So for D1 category, RBI says that for secured portion, provisioning to be done is 25% of the secured. That is what RBI say. That is the provisioning. 25% of secured. Now, can you tell me what is the unsecured portion? What is the unsecured portion? Very simple. 50 minus 20. Right. 50 minus 20. So how much? 75% of unsecured. 75% of unsecured means 75% of 30 lakh. What would that be? 75% of 30 lakh is how much? So it will be, I think 22.5 lakh. Right. So that means government guarantee cover 22.5 lakh. Now what is the bank net unsecured exposure? So net unsecured exposure is how much? Very simple. 30 minus 22.5, which is equal to 7.5 lakh. Right. So now the question is, how much is the provisioning? How much is the provisioning or unsecured? So unsecured we have 100% provisioning. 100% of 7.5 lakh. That would be 7.5 lakh. Right. So if you talk about the total provisioning, if you look at the total provisioning, it is how much? Secured is 5 lakh. Unsecured is 7.5 lakh. So total become 12.5 lakh. That is why 12.5 lakh is the correct answer. Yes, let's look at the correct answer here. The correct answer is 12.5 lakh. So we have to separately calculate, right, for secured and unsecured. So what we learned from this discussion is that, remember, for secured portion, right, for secured portion in D1, provisioning is 25%. For unsecured portion, provisioning is 100%. If a guarantee like CGTMSE is available, reduce the exposure accordingly. Right. And total provisioning is sum of all of them. So that is how, because of this CGTMSE coverage, right, earlier one secured was 30 lakh. Now it reduced to just 7.5 lakh. That's why it is zero. So friends, the key takeaway is that always split the loan into secured and unsecured. Apply RBI provisioning percentage. And don't forget to adjust for guarantee schemes like CGTMSE. I hope this is a clear explanation to this particular question. Now, let's look at the next question. Question is asking you, which of the following statement about the leverage ratio is or are correct? Option number A, the commonly accepted leverage ratio is calculated as total outside liability by tangible net worth, where TNW is net worth minus intangible asset. Option B, it says that a conservative approach to leverage considered adjusted TNW, which exclude loan, advances and investment in group associate subsidiary company. Option C, the term debt equity ratio can indicate the ratio between debt and margin in a project financing or long-term debt divided by net worth in an existing company. And option D, in financial or media analysis, solvency is tested like or total outside liability divided by net worth expressed as a plain ratio. Now let's start with option number A. So if you talk about the option number A, it says that, let me give you one example to give you a clear picture of it, how it works like, right? So here, let me give you one example. Let's suppose that a company has 100 crore liability, 100 crore liability of a company, and the net worth they have is 50 crore. Fine. But out of this 10 crore, right, out of this 10 crore is goodwill. And you know goodwill is a kind of intangible asset, right? So what is the tangible net worth? Tangible net worth is how much? Very simple, 50 minus 10, which is equal to 40 crore. That is our tangible net worth. Simple. Out of net worth, you subtract the intangible, you will get tangible. 40 crore is the tangible net worth. So leverage ratio is what you know. This 100 divided by 40, liability divided by 40, which is equal to 2.5 times. So it means that for every 1 rupees of the real money owner puts in, company has borrowed 2.5 from outsider. So this denominator shows what? 40 crore. 40 crore means what? 40 crore is your tangible net worth. Tangible net worth means for every 1 rupee of the real money puts in, company has borrowed 2.5 from outsider. That is the liability, right? That is what leverage ratio tells you. How much leverage you have taken, how much you have borrowed. Leverage means borrowing power. So in the numerator, we always write how much we have borrowed versus how much net worth. Now, what is option number B says? Option A we have just discussed. Option B says that a conservative approach to leverage considered adjusted T&W, which exclude loan, advances, investment in group, associate, subsidiary company. So why? This is correct. Why this is correct? Because if you have invested money in your own group company, that money is not freely available to pay the creditor. So bank cut it off. So let me illustrate it with using an example. Let's say that T&W is 40 crore. Tangible net worth is suppose 40 crore, right? But you have rupees 5 crore. So 5 crore invested in your sister company. So 5 crore has been invested in the sister company. So what would be the adjusted T&W? So adjusted tangible net worth would be how much? Very simple. 40 minus 5, which is equal to the 35 crore, right? So it gives a strict picture, right? It gives you a strict picture. Now what about option number C? Option number C says that, it says that the term debt equity ratio can indicate the ratio between debt and margin in a project financing or long-term debt versus net worth in an existing company. So you see, if you have a new project, try to understand. If you have a new project, that suppose project cost is 100 crore, right? So let's take one example to illustrate it. Suppose we have a new project and the cost of project is suppose 100 crore, and suppose the debt which we have taken is suppose 670 crore, and the promoter margin, or we call it equity, is 30 crore obviously. So what is the debt equity ratio? This is 70 upon 30, which is equal to 2.33. This is for new project. Suppose we have an existing company. If it is an existing company, suppose long-term loan is 60 crore, net worth is 40 crore. In this case, debt equity ratio is how much? It is nothing but 60 upon 40, which is equal to 1.5, right? So it has two meaning. That is the correct one, right? D can indicate the ratio between the debt and margin or long-term debt versus net worth. Yes, this is also correct. What about D? In financial or media analysis, solvency is tested like total outside liability divided by net worth. So you will often read the headline like company X has solvency ratio of 2.8. So what does it mean when I say company X has solvency ratio of 2.8? It means that for every 1 rupees of its money, company owes 2.8 to the outsider. So what we learned from this discussion is that, all the 4 options A, B and C, G and are correct. Yes, all the 4 options are correct. So correct answer is 4. So what we have learned, let me summarize. First we talked about the leverage ratio. Leverage ratio is simple. Total outside liability divided by tangible net worth. Tangible net worth is net worth minus intangible asset. Just understand leverage means how much you have borrowed fund as compared to how much fund the owner has put into the system.
Affected its capital structure, right? And here is the financial data we are working with. The first is long-term debt, $5 lakh. The next is current liability, $2 lakh. Shareholder equity, $4 lakh. Net income, $50,000, and total asset, $12 lakh. Now the question asks us to calculate the debt equity ratio, that is called DER. And options have been given. There are 4 options. Okay, so now which one is it? So first let's define what we are calculating. We are calculating the debt equity ratio, that is called DER. So this ratio shows the relationship between the company debt and net equity. Two things are there. Now, the first thing is company debt, and the second thing is equity. So in simpler terms, it tells us how much debt the company has for every dollar of equity. Now to calculate this ratio, we've only considered long-term debt. So we are not including current liability in our calculation, just the long-term debt. Right to understand, this is very important. We are including only long-term debt, right? So we will modify our formula like this: DER is equal to long-term debt. Earlier I wrote debt, but now I am writing long-term debt divided by shareholders equity. So now in this case, can you tell me what is the long-term debt? Let me move to the previous slide, and you can see it here. Long-term debt is how much? $5 lakh. So our numerator will be how much? Our numerator will be $5 lakh. And what about the shareholder equity? It is nothing but $4 lakh. So if we divide both of them, what you will get? You will get debt equity ratio which is equal to 1.25. If you divide both of them, you will get 1.25. So the correct answer is option number A, that is 1.25. So now the question is, what does this 1.25 really means? Well, it tells us that XYZ Limited has 1.25 of long term debt for every dollar of equity. यानी $1 इक्विटी के लिए, $1 इक्विटी के लिए, यानी ₹1 इक्विटी के लिए कंपनी एक्स के पास जो XYZ के पास टोटल $1.25 जो है डेप्ट है. तो you can see it clearly that ratio is greater than 1. That means DER is greater than 1. So a ratio D greater than 1 indicates that company is using more debt than equity. Obviously ये ratio क्या indicate कर रहा है? ये company जो है debt ज़्यादा use कर रही है as compared to equity to finance its operation. ऐसे केस में क्या होगा कि एक्सपेंशन प्रोजेक्ट लाइकली इंक्रीज द कंपनी रिलायंस ऑन डेप्ट. तो ऑब्वियसली बात है, इन सच केस द एक्सपेंशन project is likely increase the company reliance on debt, which is reflected in the debt equity ratio. तो दोस्तों ये डेप्ट इक्विटी रेशियो को समझना बहुत जरूरी है, क्योंकि ये इन्वेस्टर को और स्टेक होल्डर को एक इंसाइट प्रोवाइड करता है कि कितना रिस्की कंपनी का फाइनेंशियल स्ट्रक्चर हो सकता है. यदि ये रेशियो ज़्यादा है, मतलब कि रिस्क ज़्यादा है, खासकर यदि कंपनी स्ट्रगल कर रही है अपने डेप्ट ऑब्लिगेशन को मीट करने के लिए. सो रिमेंबर, हायर रेशियो कुड मीन्स मोर रिस्क, स्पेशली इफ द कंपनी स्ट्रगल टू मीट द डेप्ट ऑब्लिगेशन. So this was about the question number 1. The correct answer is 1.25. Now let's move on to the question number 2. So in this question we are going to interpret the debt equity ratio we calculated the earlier for one XYZ Limited. Okay, so first question is what does the debt equity ratio is of 1.25 indicates about XYZ Limited financial structure. Earlier we have about this answer 1.25. Now it asks to interpretation. Options are: the company is heavily reliant on equity financing, the company is using more debt related to equity, the company has an optimal capital structure, the company has no debt. Equity ratio है यानी DER is 1.25. What does it mean? It clearly means that for every dollar of for every one unit of equity, so it means for every 1 unit of equity the company has 1.25 unit of debt. That is means सिंपल सा मतलब है कि 1 यूनिट इक्विटी के लिए कंपनी के पास 1.25 यूनिट है डेप्ट का. इन सिंपलर टर्म्स, XYZ लिमिटेड इज यूजिंग मोर डेप्ट देन इक्विटी टू फाइनेंस इट ऑपरेशन. दिस इज द की इंडिकेटर दैट कंपनी इज रिलाइंग हैविली ऑन बोरोड फंड. इसका मतलब यही ना हुआ कि कंपनी जो है हैविली रिलाई कर रही है किस पे? बोरोड फंड पे रिलाई कर रही है ताकि अपने बिजनेस एक्टिविटी को फिल करें. चलिए ऑप्शन वाइज चलते हैं. पहला ऑप्शन कह रहा है कि कंपनी इज हेवली रिलायंट ऑन इक्विटी फाइनेंसिंग. तो ये सही तब होता जब रेशियो 1 से कम होता, ठीक है, तब ये सही होता. लेकिन इस केस में रेशियो 1.25 है, तो ये ऑप्शन गलत है. ऑप्शन बी कह रहा है कि द कंपनी इज यूजिंग मोर डेप्ट रिलेटिव टू इट्स इक्विटी। ये बिल्कुल सही है, 1.25 रेशियो यही इंडिकेट कर रहा है। ऑप्शन सी कर रहा है कि कंपनी हैज एन ऑप्टिमल कैपिटल स्ट्रक्चर। देखिए रेशियो यदि 1 के आसपास हो ना, तब फिर वाइल अ रेशियो अराउंड 1 कुड बी कंसिडर्ड बैलेंस, वेदर इट इज ऑप्टिमल डिपेंड्स ऑन इंडस्ट्री, कंपनी गोल एंड अदर फैक्टर। ऑप्टिमल है या नहीं, ये कंपनी गोल पे डिपेंड करता है, दूसरे फैक्टर्स पे डिपेंड करता है, लेकिन इस कंटेक्स्ट में हम सिंपली इंटरप्रेट कर सकते हैं कि ये रेशियो बेस्ट फिट नहीं है। ऑप्शन डी कर रहा है कंपनी हैज नो डेब्ट, ये तो ऑब्वियसली गलत है। द कंपनी हैज नो डेब्ट ऑब्वियसली विद अ रेशियो ऑफ 1.25, द कंपनी डज हैव अ डेब्ट एंड दिस ऑप्शन इज इनकरेक्ट। So what we can see that this ratio 1.25 suggests that the company is somewhat leveraged. So we can say that this ratio 1.25 suggests that company is somewhat leveraged, meaning it has taken on significant debt relative to its equity. A stakeholder who need to monitor this to ensure that company does not overextend itself and end up in financial trouble, right? So you can see understanding the DER help us in assessing a company financial structure and potential risk. A ratio above 1 indicates a high reliant on debt, which could either be a strategic move or a potential risk depending on the situation. So hopefully this concept is clear now. चलिए आगे बढ़ते हैं हम लोग, क्वेश्चन नंबर 3 पे आते हैं। देखिए ये एक सीरीज था, एक केस स्टडी था डेप्ट इक्विटी रेशियो पे, इस प्रकार के सवाल आए थे। क्वेश्चन ये आपसे पूछा जा रहा है कि when a company reduces its debt specifically how that affect the debt equity ratio. Now suppose the company reduces the debt, so how DER will be affected? So here is the scenario, if XYZ Limited अपने लॉन्ग टर्म डेप्ट को $1,00,000 से कम करना चाहते हैं और शेयर होल्डर के इक्विटी को कांस्टेंट रखना चाहते हैं, तो नया DER क्या होगा? तो सबसे पहले आपको याद रखिए, रिमाइंड कीजिए अपने आप को। फर्स्ट ऑफ ऑल लेट अस रिमाइंड आवरसेल्फ ऑफ द ओरिजिनल DER व्हिच वाज 1.25, वी हैव जस्ट कैलकुलेटेड। सो ओरिजिनली जो हमारा लॉन्ग टर्म डेप्ट था, ठीक है, लॉन्ग टर्म डेप्ट जो था ओरिजिनल, यहाँ पे मैं ओरिजिनल लिखता हूँ। सो ओरिजिनल जो लॉन्ग टर्म डेप्ट था दैट वाज हाउ मच, दैट वाज $5,00,000, राइट। एंड नाउ ओरिजिनल शेयर होल्डर इक्विटी, ओरिजिनल इक्विटी शेयर होल्डर का इक्विटी जो ओरिजिनल था हमारे पास वो था 4 लाख, राइट। तो ये तो ओरिजिनल वाली बात हो गई। अब क्या हुआ कि इसने डेप्ट को 1 लाख से कम कर लिया, तो जो फाइनल डेप्ट है इट हैज़ रिड्यूस्ड बाय 1 लाख विच हैज़ बिकम $4,00,000, राइट। इट हैज़ बिकम $4,00,000 because it has been decreased by 1 lakh. You can see reduces long term debt by 1 lakh. So the shareholder equity remain constant. It is almost 4 lakh only, right? So now can you tell me what is the new DER? So new DER will be how much? This long term debt divided by shareholder equity, which is nothing but 1, right? So the correct answer is 1. Option number A is correct. That is what is the new DER, which is nothing but 1. So this new DER, what does it tells us? Well, now that the debt and equity are equal, XYZ has a balanced capital structure where every 1 unit of equity is matched with 1 unit of debt. This might be more comfortable position for the company as it reduces its financial risk by lowering the amount of debt. Reducing debt can be a smart move for a company if it want to decrease its financial risk, and it definitely affect key financial ratio like the DER. In the XYZ case, bringing the ratio down to 1 suggests a more balanced and potentially safer financial structure. Hopefully this concept is clear now. Now let's come to the next question. Next question is why might a company with a high debt equity ratio be considered a disadvantage? So very good question कि किसी कंपनी का हाई DER है तो वो डिसएडवांटेज क्यों है? Let's go through the option. First option से because it means the company is using more equity financing. This is actually wrong. Actually high DER suggests the opposite. It means company is using more debt, not equity. So option A is incorrect. Option B says because it indicates high dependency on debt which could affect its ability to service the debt in the event of low profitability. So this is the right answer. When we talk about high DER, if we talk about high debt equity ratio, it indicates that the company rely heavily on borrowed fund. What does it indicate? That company rely heavily on borrowed fund. Company is relying heavily on borrowed fund. If the company profit fall, it might struggle to make interest payment and repay the principal, putting it in a risky financial position, right? So high DER, what does it mean? It indicates company rely heavily on borrowed fund, and in such case, if profit fall, it might struggle to make interest payment and repay the principal. So this is how this high DER is not considered a advantage, it is considered a disadvantage, right? So this is the correct answer which could have. And suppose the company profit fall, low profit is there, then how company could manage its principal and interest payment, right? It could not manage. So option C says because it suggests the company is not investing enough in the capital intensive project. So while a high ratio could limit a company's ability to invest in project, this is not the direct reason a high debt equity ratio is disadvantage. So this is not the best answer. And option D says because it means the company is highly profitable. So high DER does not directly indicate profitability. In fact, it could be the sign of financial strain if the company is unable to generate enough profit to service its debt. So option number B is the correct one. Right, a high DER shows the company is heavily reliant on debt to finance its operation. While debt can be cheaper source of funding than equity, especially when interest rates are low, it also comes with obligation like regular interest payment and eventually repaying the principal. If the company profit falls, it might struggle to meet these obligations, lending to financial distress or even bankruptcy in several situations. That's why a high DER can be risky, and why company with this kind of ratio might be at disadvantage compared to those with a low ratio. So in summary, while debt can be an effective way to fuel growth, too much of it can put a company at risk, especially if the profit is not stable. So always keep an eye on company debt equity ratio while analyzing its financial strength. So that's the point which we are covered in this particular slide. Let's move on to the next question. The next question says that why the debt equity ratio might not be the best tool for comparing company in different industry. Very good question. So there are 4 options are given. Option A says because different industry have different level of capital intensity. So what do you think? This is the correct answer. Industries like manufacturing. Let's talk about some industry like manufacturing and utilities, which are capital intensive industry. So these industry manufacturing are capital intensive. So they tend to have high DER. They have high debt equity ratio. They tends to have high DER due to large investment in long term asset. Why they have high DER? Because they have large investment in the long term asset. On the other hand, industry like technology industry, or suppose consulting industry, so these industry which are less capital intensive, they might have a lower DER, right? They might have lower DER. Why? Because this difference makes direct comparison between companies in different industry less meaningful, right? So option A is the correct one. Option B says because the ratio does not account for market condition. So while it is true that debt equity ratio does not reflect the market condition, this is not the reason it is not applicable for cross industry comparison. Option C says because companies in different industry uses different accounting practices. So different accounting practices can affect financial ratio, but this is not the primary reason the debt equity ratio might not be comparable across industry, right? Option C says because companies in different industry uses different accounting practices. Different accounting practices can affect financial ratio, but this is not the primary reason. Option D says because it only considers short-term liabilities. Actually, the debt equity ratio focuses on long-term debt, not short-term liability. So this option is also incorrect. What is the correct option? The correct option is option number A. So the debt equity ratio reflects how much a debt company is using to finance its operation as compared to equity. However, the amount of debt a company needs can vary significantly depending on industry. For example, some industry that requires heavy investment in physical asset like manufacturing, they have typically high DER. This is because they often finance the large investment with debt. On the other hand, service-based industry or technology company might have lower DER. Come on to the next case study that we have, which is related to the PEP, right? Break even point. So let's see the question. The question is like this: ABC Limited manufactures and sell custom-made widget, and they want to determine their break-even point in units. So here are the financial details given. Like selling price per unit is given $10, variable cost per unit is given $6, fixed cost is given $2,000, and the question is asking you to calculate how many. That is the break-even point you have to calculate. And what is break-even point? You know what is this break-even point? So this break-even point means what? How many unit does ABC Limited need to sell to break even? Friends, if you are preparing for CCP examination, that is IIBF certification course CCP, and if you are looking for any study material, a perfect study material which caters to your need, either in the form of PDF, videos, quizzes, previous year questions, then you can contact me on this particular number. We have an course available for the CCP examination, and this will help you to achieve good marks in the examination at with lower effort. With low effort, you can get the maximum output. So if you are interested in this, kindly WhatsApp me on the number shown on the screen, and in the description section also I have provided the link of the courses. Now let's come back to this particular question. So we have to calculate the break even point in units. So you know what is what is break even point. So see, first of all we will go through the formula, that is fixed cost divided by selling price per unit minus variable cost per unit, right? So this is how we calculate the break even point. So this is by using the formula, right? But I am telling you a best way to solve such type of problem. No, not using the formula, because sometimes if you wrongly wrongly remember the formula, everything will be wrong. So let me give you an insight into this thing. See, try to understand what I am saying, that suppose you have to draw this type of pie chart. Okay, so this is a circle. Okay, and this complete circle has two parts, right? So there is a selling price per unit, and there is a variable cost per unit, and there is a fixed cost per unit, right? So the total cost will comprise of two things. What is the meaning of this fixed cost? Fixed costs are the costs that do not change no matter how many units you produce. So this will not change, this will remain constant. What is the selling price? This is the amount that ABC Limited charges for each widget. And what is the variable cost? It is the cost to make each widget. See, let me make you understand using this particular circle. So this entire circle represents the selling price, and you know the basic formula, that selling price is equal to cost price plus profit, or it may be loss minus loss, right? This is the thing. Okay, so what you do, you divide this particular circle into two parts. Okay, so this part represents the variable cost. Okay, and if you subtract this selling price minus variable cost, this will give you contribution margin per unit. This will give you contribution margin per unit, or you may represent it by small c. So this portion which I am showing by suppose I take this color. Okay, so this portion is what our called contribution margin. This is called contribution margin. Now if we talk about this contribution margin, let me move on to the next slide. Yeah, so let's come to this slide. Let me erase this thing. Hopefully you have understood what is contribution margin. And see, if we talk about this contribution margin is make up of two things. See, let me draw it again. I think it is not drawn perfectly. Yeah, try to understand this concept. This is very important concept. Once you understand this concept, you can solve any type of break even point question easily. See, this is our contribution margin. This contribution margin is comprises of two things. The first thing, it comprises of fixed cost, and the second thing, it comprises of the profit, right? So two things are there in the contribution margin, that is fixed cost and profit. So what I do, I have just exaggerated this particular portion in the form here, and suppose I draw this is the center, this is the point, and I said this particular point, I said this particular region. Okay, and I also said this particular region. So this portion, suppose it represent our fixed cost, and this portion suppose it represent our profit, right? So you can see this contribution margin, this entire portion contribution margin, it comprises of fixed cost and profit, right? So what is the meaning of break even point? Break even point means a point at which profit is zero. a point at which profit is zero. Now you can see, if the profit is zero, then this shaded region will become zero, or we can say it quite easily that this entire fixed cost will become equal to our contribution margin. Right? Am I clear? What I'm saying that what is the meaning of break even point? Break even point means this profit is zero, and when profit is zero, this fixed cost will be equal to contribution margin. Right? So this is how we will calculate it. So now let's go back to this particular question and let's dive into how to calculate using this particular thing which we have discussed just now. So see, this entire circle is how much? $10. Okay, and this portion which is variable cost is $6. So this portion will be $4. This is $4. Right? Now this $4 is our contribution margin per unit. Okay, and we know at break even point contribution margin is equal to our fixed cost, and this contribution margin can be written like contribution margin per unit into number of unit is equal to fixed cost. Now you know what is contribution margin per unit, which is nothing but $4. Number of unit we want to know, suppose n is the number of unit, and fixed cost we also know, fixed cost is how much? $2000. So you can simply calculate n is equal to 2000 divided by 4, which is nothing but 500 units. So this 500 units is our what? This is a 500 units is our break even point. That means, what does it mean? That means ABC Limited need to sell 500 widgets to cover all its fixed and variable cost. There will be no profit, but it will be able to cover its fixed and variable cost. At this point, company is not making any profit, but it is not losing money also. It is breaking even. Any sales beyond 500 unit will start generating profit for the company. So understanding break even point is crucial for any business. It helps to set sales target and make informed decision about pricing and cost. Right? Now let's come to the next part of this particular question. Now suppose the next question is, what is the break even point in terms of sales revenue for ABC Limited? Try to understand. Earlier it was asking break even point in units, and we got the answer 500 units. But now the question is in terms of sales revenue. Very good question. So in terms of sales revenue, how can you calculate? It's quite simple. See, you know how many units you require to break even, and you simply multiply the number of units with selling price per unit. Right? You will get break even point in terms of sales. How many units are there? 500 units are there. And what is the selling price per unit? Tell me, what is the selling price per unit? It is nothing but $10. Right? It is nothing but $10. So the break even point in terms of sales revenue is how much? $5,000. So what does this $5,000 represent? So it is the total amount of revenue that ABC Limited needs to generate to cover both its fixed and variable cost. In other words, if ABC Limited brings in $5,000 from selling its widget, it won't make a profit, but it won't incur a loss either. It will just break even. Right? So earlier we calculated break even point in terms of unit, and now we calculated the break even point in terms of sales revenue. Now let's come to the third part of this particular question. The third part is, what is the margin? What does the margin of safety measure? See, first of all, question is asking what does margin of safety measure, and the next part is what is the margin of safety? That's the point. See, margin of safety, what are the options? The difference between actual sales and break even sale. So this is the correct answer. Margin of safety tells you how much your current sale exceeds the break even point. Right? How much this is your current sale. Suppose this is your current sale level and this is your break even point level. Right? So essentially it measures how much sale can drop before the business start incurring loss. Option B say the total fixed cost covered by the sale. This is wrong. This sound close, but it's actually not what the margin of safety is. Option C says the profit earned beyond the break even point, while this sound close, but it's actually not margin of safety measure. Option D say variable cost and fixed cost difference. This is not margin of safety. Right? So the correct answer is option number A. Let's talk about why margin of safety is important. Imagine your business is doing well and you are selling more than the break even amount. The margin of safety tells you by how much. This is crucial because it shows how much sale can drop before you start losing money. For instance, let me give you an example to make it more clear. For instance, suppose your margin of safety is high. So in that case, you have a larger cushion. You have a larger cushion. right? Which means you can withstand the decline in sale without worrying too much about dipping into loss. On the other hand, a low margin of safety indicates that even a small drop in sale could put you in business at risk. So understanding the margin of safety help you gauge the financial health of your business. It is a great way to assess risk and make informed decision. So next time you are looking at your sales figure, don't forget to calculate this important metrics, that is margin of safety, right? Hopefully the why option A is correct is clear now. Now, why it is important for a company to calculate this break even point? Very good question. So options are to determine the maximum profit that can be achieved. No, this is wrong, because break even point does not tells you about your profit. It is actually covering cost. Option B says to understand the level of sales needed to cover all costs and avoid losses. See, now this is correct answer. The break even point is all about finding out the minimum sales volume required. The break even point is finding the minimum sales volume required to ensure that all the cost, both the fixed and variable, are covered. It is a point where your business is not making a profit, but it is also not incurring any loss, right? Option C says to calculate the amount of debt that can be handled. See, while debt is important consideration for any business, it does not directly relate to the break even point. Option D say to decide the selling price of the product. So setting the selling price involves many factors, but the break even point is specifically help in understanding the sales volume. So why it is knowing your break even point is so important? It is simply the foundation of financial planning. If you don't know the minimum amount of sale you need to avoid any losing money, you are flying blind. Understanding your break even point help you set realistic sales target, manage your expense. For example, you know you need to sell 500 units just to break even. You can strategize around that target, whether it is adjusting your marketing effort, cutting cost, or even reevaluating your pricing. So calculating break even point is not just a good practice, it is must for any business that want to stay afloat and grow. It gives you a clear picture of where you stand and what you need to do to succeed. Now let's see the last part of this particular question. If ABC Limited want to achieve a profit of $1,000, how many units must it sell? Very good question. So how many units it must sell to achieve a profit of $1,000? So how to calculate this? So earlier I have told you to do this particular diagram. So see, what is the selling price per unit? Selling price per unit is 10 rupees. What is the variable cost? It was 6 rupees. So this area is how much? 4 unit, which is called contribution margin per unit, right? And in this case, if you exaggerate this particular area, it has been given that profit is $1,000. So this area is profit and this area is fixed cost, right? And fixed cost is given how much? $2,000. I think you remember it. $2,000, right? So you know contribution margin is 4, contribution margin per unit is 4. So we can say contribution margin per unit multiplied by number of unit, this would be equal to how much? 2000 plus 1000, which is equal to 3000, right? And what is the contribution margin per unit? It is nothing but 4. So 4 multiplied by n is equal to 3000, right? So n is equal to how much? 3000 divided by 4, which is equal to 750 units. Is it clear now how to calculate it? No need to remember any formula, just remember this particular circle. Again I am repeating this question. See what you have to do. The selling price is given 10, the variable cost is given 6, so your contribution margin per unit, which is denoted by small c, is equal to 4. And this contribution margin comprises of the two part. The first part is fixed cost and the second part is what? Your profit, right? So this contribution margin capital C is equal to the fixed cost plus profit. What is fixed cost? $2,000. What is profit? $1,000, which is nothing but 3,000. Your contribution margin is 3,000, and contribution margin is represented by contribution margin per unit multiplied by number of unit, which is small c. It is a small c, right? So c into n barabar 3,000. So n is equal to how much? 3,000 divided by small c. And what is a small c? A small c is 4. So it is nothing but 750. Is it clear now? So this way you have to solve such type of problem. You no need to remember any formula.
Bankruptcy code. Which of the following is not a key component or authority involved in the resolution process? So you have been asked which is not a key component or authority involved in the resolution process. Let's go through the option. The first option say resolution professional. So let me give you a brief idea. So it is a central to IBC process. If we talk about this in short, we call it RP. So RP is the central to the IBC process. They manage the insolvency process. Not only manage, they coordinate between creditors and oversee the preparation of the resolution plan. So think of them as a project manager. You can think of them like a project manager, ensuring that all stakeholders are on the same page to resolve financial issue. Right, so they ensure that all the stakeholders are on the same page to resolve financial issue. That is called resolution professional. Second option, we say information utility. Yes, correct. So the information utilities, you can think of them like a database, that store and authenticate financial information of debtor. So that stores and authenticate financial information of debtor that help in faster decision making. Right, so imagine a digital library that gives verified financial data instantly. You can imagine them like a digital library which give verified financial data instantly. So this help creditor and professional act swiftly. The third option say executive authority. So see, executive authority, if we talk about, so you know about NCLT. NCLT is National Company Law Tribunal, and you know about this DRT, Debt Recovery Tribunal. So this NCLT and DRT act as the adjudicating authority. They approve or reject insolvency application and ensure fair proceeding. They are like judges in the courtroom, deciding whether a case qualify for the resolution process or not. And the option D says interim resolution professional. So this is the incorrect option. There is no concept of interim resolution project in the IBC. Instead, the correct term is interim resolution professional. I think this no project, right? So this the correct answer is IRP, interim resolution. We can call it interim resolution professional, who temporarily manage the insolvency process until the resolution professional is appointed. So the correct answer is option number D. So what is the key takeaway from this particular question? First of all, we have seen the RP, which is the main person managing the insolvency resolution process. We have seen the information utility, a trusted source of financial data for quick decision. Then we have seen the executing authority, the body that oversees and approve the resolution process. Right. So this thing. Now let's move on to the next question. Let's see what type of question are being asked in the examination. So question number 2, which of the following is appropriate in the project appraisal? Friends, if you are preparing for CCP, obviously you are preparing for CCP, then you can join our Telegram channel where you can find such type of questions. The link of Telegram channel is provided in the description section. So you will get exposure to what types of more questions are being asked in the examination. Okay, there are almost 500 people who have already joined the Telegram session, so you can take help of their experience also. Now let's see the next question, which of the following is inappropriate in the project appraisal? So the question is in which of the following is inappropriate in the project appraisal? The first is checking the borrower background. Option 2 says that verifying transaction check on a regular basis. Option 3, assessing the borrower's payment capacity, and option 4, evaluating cash flow for the project. So which is inappropriate? So let's see the first option, that is checking the borrower background. So this is the standard part of project appraisal. Lender need to assess the borrower credibility and past financial behavior to minimize the risk. So imagine you are lending money to a friend. Would not you want to ensure that they are trustworthy and have repaid debt in the past? So that is what this is a part of the project appraisal. Verifying transaction check on a regular basis. So this VTC, it is also called VTC, that is verifying transaction check on regular basis. See, this is inappropriate for project appraisal. While monitoring transaction is essential during project implementation, it is not part of the initial appraisal process. The focus of the appraisal is on feasibility. The focus on the appraisal is on feasibility, not day-to-day transaction. This is the main focus, not day-to-day transaction. Think of this as trying to monitor a project daily cash flow even before deciding to fund it. It does not make sense, right? The third option says assessing the borrower payment capacity, right? So what do you think about this? This is the crucial part. Understanding if the borrower can repay the loan ensures the lender's money is used wisely. Right, obviously borrower payment capacity plays a crucial role. And let's see the fourth option. So I can give you example to make option 3 more clear. It's like checking if someone can afford a loan before approving it, and option 4 says evaluating cash flow for the project. So this is the key part of project appraisal. Lender need to ensure that project can generate sufficient cash flow to repay the loan and sustain itself. It's like ensuring a business plan is profitable before investing it. So what is the correct answer? The correct answer is option number 2. So this is the correct answer, verifying transaction check on a regular basis, right? So what is the key takeaway from this particular question? So we have seen that checking the borrower background and payment capacity is essential to minimize lending risk. Evaluating cash flow ensure the project financial feasibility. And third thing we have seen, verifying transaction check is not a part of appraisal stage. It is relevant during the project implementation phase. Now let's move on to the next question. So let's see what is the next question that we have. As on now, how many core investment, I think CIC, credit investment company, for the, this is not the correct full form, I think it is credit information company, right? CIC means credit information company. So let me correct it. How many credit information company have been declared by RBI at the domestic level? So at the domestic level, you know, at the domestic level and at the international level, there are different types of CICs. So you have been asked to find how many CICs are there at the domestic level. So now the correct answer is 4. There are 4 CIC. Okay, let me name them. Let me provide you the name of them also. So you can see these are Credit Information Bureau Limited, that is called CIVIL. We call it CIVIL. CIVIL full form is Credit Information Bureau India Limited. And then after we have Equifax, right? Equifax. So Equifax Credit Information Service Private Limited. This is the second one, Equifax Credit Information Service Private Limited. First is Civil. The third is Experian Credit Information Company of India Private Limited. And the fourth is CRIF Highmark. So these are the 4 CICs in India, right? Credit Information Company. Now let's see the next question. Is ROC, you know what is ROC? ROC is Registrar of Company. Is ROC filing compulsory for LLP, that is Limited Liability Partnership? So the question is whether ROC filing, you know, every partnership has to registered with ROC. So whether it is compulsory for LLP also or not. So option, let's see the option. The first option say no for unregistered LLP, it is not mandatory. See, this is wrong. There is no concept of unregistered LLP, because an LLP must be registered under the Limited Liability Partnership Act 2008. You must remember it. This registration is mandatory. It's like saying you are part of a club without officially signing up. That does not work. Now, sir, option 2 says that only bank consider ROC for LLP. This is also incorrect. While bank may check ROC filing for verifying an LLP compliance, registration with ROC is a statutory requirement under the LLP Act, not just for bank. Registration with ROC is compulsory for LLP. This is the correct one, right? See, filing with ROC is mandatory for LLP. It ensures legal recognition and compliance with regulation, such as filing annual returns and financial statement. Imagine you are starting a business as an LLP. Without registering with ROC, your LLP cannot legally exist or operate. Option 4 says filing with ROC is optional for LLP. This is incorrect. Filing with ROC is not optional. It is a legal requirement for LLP to maintain their status and avoid penalty. So what is the correct answer? Option number 3 is the correct answer. So let me just summarize the key fact which we have covered just now. That registration with the registrar of company, that is ROC, is mandatory for all LLP under the Limited Liability Partnership Act 2008. Filing with ROC ensure that LLP is legally recognized and remain compliant with a statutory requirement like filing annual returns. Non-compliance can lead to penalties and legal issues for the LLP. Right. So this is about ROC and LLP condition. Now let's see the next question. A company has the following financial ratio. So this is a good question based on numerical part which have been asked in the examination. So you have been provided the financial ratios like current ratio given 1.5, quick ratio is given 1.2, inventory turnover ratio is given 6, current liability is given 1 lakh. You have to find the COGS. What is COGS? Cost of goods sold. So now let's first calculate step by step. So you know the current ratio. What is the formula of current ratio? It is nothing but current asset upon current liability. Okay, now see, it is given 1.5. So 1.5 will be how much? Current asset upon current liability, and current liability is 1 lakh. So you can say current asset will be how much? 1.5 times CL, or you can say 1.5 times 1 lakh. So this will be how much? 1,50,000. So this will be our current asset. Okay, now we know the current asset. Now let's move on to the quick ratio. Let's take help of this quick ratio. What is the formula of quick ratio? Let me write down here. That is nothing but quick asset upon current liability, and this is given 1.2. So 1.2 is equal to quick asset upon, and current liability is 1 lakh, right? So how much will be the quick asset? So the QA will be 1.2 times 1 lakh. So this will be how much? 1,20,000. So quick asset is given 1,20,000. Current asset is given 1,50,000. Okay. Now what is the difference between the quick asset and the current asset? You know, see, quick under current asset also includes inventory. So you can say current asset is equal to inventory plus quick asset. Okay. So the difference is inventory. So can you tell me what will be the inventory value here? You can say inventory is equal to current asset minus quick asset. What is the current asset here? That is 1.5 lakh. And what is the quick asset here? 1.2 lakh. If we subtract, this will give you 30,000. So 30,000 will be the inventory. Now we know the inventory. Okay, and one ratio is also given, inventory turnover ratio. Let me erase it up. I think there is no space, so let me erase it and I will do the further calculation here. So what is inventory turnover ratio? Tell me, what is inventory turnover ratio? You know the formula? Let me remind you. I think you know the formula. Inventory turnover ratio, ITR, is equal to COGS upon inventory. This is simple formula, right? So we know ITR, inventory turnover ratio, is given to us 6. So in the place of ITR we will write 6. COGS we have to calculate, that is cost of goods sold, and we know the value of inventory, which is 30,000. So let me write here 30,000. So what is the COGS? So COGS is nothing but 30,000 multiplied by 6, which is 1,80,000. So I think there is no option here, but suppose there is a fifth option, that suppose there is a fifth option here, that is 1,80,000. So that would be the correct answer, right? 1,80,000. Okay, so hopefully you have understood this particular concept. Okay, inventory turnover ratio, how to calculate this COGS, this is how you have to go do it. Okay, now let's see the next part. What is the maximum period for which packing credit in Indian rupees can be extended to exporter as per RBI guideline? Friends, before going to the option, let me tell you that if you are looking for study material for CCP, in our app, that is JIV and CIV Made Simple app, you will find an exhaustive study material for CCP, in which we provide unit-wise theory, unit-wise MCQs, as well as previous year questions. All these things are available in the form of PDF, which is completely downloadable, and you can take print for offline reading also. So in the link beside in the description section, I have provided you the course link. You can directly go to the course and you can get each and every unit's theory portion, concise notes, complete MCQs, which will help you revise the concept. For more detail, you can WhatsApp me on this particular number also. Now let's see the next question. Question is, what is the maximum period for which PCIR, that is packing credit in Indian rupees, can be extended to exporter as per RBI guideline? Tell me, what is the maximum number of days? So PCIR can be extended to the exporter as per RBI guideline. What is the maximum number of maximum period? So options are 120, 180, 360 and 90. See, first of all, let's understand what is PCIR. Packing credit in Indian rupees. PCIR is a short-term pre-shipment credit. It is a type of pre-shipment credit. It is a type of pre-shipment credit provided to the exporter. It helps exporter finance activities like purchasing, processing, manufacturing or packing goods meant for export. If we talk about the duration, so RBI allowed packing credit for a maximum period of 180 days. For the maximum period of 180 days, this is allowed. Okay, from the date of disbursement. Date of disbursement to 180 days. Okay, if additional time is needed, bank can consider extension in exceptional case, but these may require RBI approval, compliance with the specific guideline. So the common duration is 180 days. Okay, now the second question is, why duration is capped at 180 days? This time frame ensures that exporter have sufficient time to process good and ship them, right? It also aligns with typical export cycle, ensuring liquidity without overstanding credit. So extension beyond 180 days, there are some exception also. It's not hard and fast that only 180 days. Yeah, exception also there. Extension beyond 180 days are rare and subject to a strict regulation. Exporter must demonstrate valid reason. Like, let me give you an example to make this concept more clear. Imagine you are an exporter of textile. Okay, you are an exporter of textile. You take PCIR from the bank. You avail the packing credit exposure from the bank to purchase raw material and prepare the shipment. As per the rule, you need to complete your shipment process within 180 days to repay the loan. And if there is an unforeseen delay, you will need to apply for an extension through your bank, which will then follow RBI approval process. So what are the key takeaway from this particular question? We have seen what is the purpose of PCIR, that a short-term credit to help exporter with pre-shipment activity like purchasing and packing goods. And we have seen the maximum duration, which is 180 days from disbursement, and we have seen extension is also possible, right? So that is everything you need to know about PCIR. If you really find this explanation useful, give this video a like, share it with your fellow learners, and subscribe to the channel for more such insight. Let's continue to the next question. So let's see what is the next question here. The next question is, as per the Tandon committee recommendation, which method gives the highest MPVF? You know MPVF, maximum permissible bank finance. So there are some certain method, first method, second method, third method, and fourth method. Okay, so which will give you the highest MPVF? So first of all, what is the Tandon committee? Let me give you a glimpse. The Tandon committee was set up to suggest way to regulate working capital financing by a bank. So main key factor is working capital financing by a bank. Okay, its main goal was to ensure that company use fund efficiently while reducing over dependence on bank credit. So that is about the Tandon committee. The second thing is MPVF. What is this MPVF? MPVF refers to the maximum amount bank can lend to business for its working capital need. The maximum amount that bank can lend to the business for working capital need is called MPVF. This committee suggested three methods to calculate MPVF. So what is the first method? What does the first method says? Okay, you will get answer if you know these four methods. If you know what these four methods are, you will clearly get the answer. The first method says that bank finance 75% of the working capital gaps. WCG. What is WCG? This is the difference between the current asset and current liability, or the CLO-BB we say, which is nothing but current liability other than bank borrowing, right? So this is what, so 75% of the WCG will be provided by the bank, and 25% will be provided by the it will be provided by the borrower, which is called borrower contribution, which is also called margin. So this is more restrictive because the borrower contribution is higher. What is the question asking? Question asking you to find which method give the highest MPVF. In which method bank will give the highest permissible finance. So it is not the correct answer. It is restrictive because borrower contribution is higher. Let's see the second method. In the second method, you know that borrower contribute 25% of the current asset and the bank finance the balance. So 25% of what? 25% of current asset. Since the borrower margin is fixed at 25%, the bank share increases. So that is why, as compared to the first method, in the second method we have higher MPVF, right? In this method we have higher MPVF. If we talk about the third method, so borrower contribute 25% of the core current asset, 25% of the CCA, core current asset. What is CCA? Maximum current asset required to operate a business. What is CCA? This is the maximum current asset required to operate the business. This is called CCA. Okay, so and the bank finance the remaining. This method is stricter as it focus on core asset only. So option D says all methods give the same MPF. This is incorrect. Now the correct answer is option number B. So the question is why the second method gives the highest MPVF? See, we have fixed the borrower contribution to the 25% of total current asset. We have just fixed it in the second method. So the bank share increase. In this case, bank share will increase. Okay, and it allows for a larger loan compare as to the other method. So let me give you an example to explain it. Let's suppose company needs 1 lakh. Company needs 1 lakh for working capital. According to the first method, bank finance 75%, which is 75,000, and the borrower will finance the rest 25,000. Okay. According to the second method, borrower contribute only 25,000 and bank finance the remaining. Right. So in terms of margin and flexibility, second method result in higher MPVF. Okay, so that's the point. Now the next question is, here it is, it has explanation is also there. In this way you will find explanation for each and every question. MCQ is also. Now the question is, who can initiate the CIRP? What is CIRP? Corporate Insolvency Resolution Process under the IBC, Insolvency and Bankruptcy Code 2016. Who can initiate this CIRP under the IBC? Tell me. Options are only principal creditor, financial creditor and operational creditor, only operational creditor, all of the above. So first of all, what is CIRP? Okay, because we are dealing with CIRP, what is CIRP? So CIRP stands for Corporate Insolvency Resolution Professional Process. It is a mechanism under the IBC to resolve case of corporate solvency. If we have to resolve cases of corporate solvency, corporate insolvency, in that case CIRP is used. So it is a legal process initiated when a company is unable to pay its debt, and it aims to revive the company or liquidate its asset to repay the creditor. Okay, so this is about the CIRP. It is a legal process when the company is unable to pay its debt, and its aim to revive the company or liquidate its asset to repay the creditor. Okay, so question is, who can initiate CIRP? Under the IBC 2016, the following entities can initiate CIRP. The first is FC. FC means financial creditor, a creditor who has provided a financial loan or credit to the corporate debtor. Okay, so for example, bank or financial institution who have provided loan to the to this particular debtor. Okay, so company is not able to paying its debt, and it aims to revive the company or liquidate its asset to repay creditor. Now the first, financial creditor. Second is operational creditor can also initiate CIRP. What is operational creditor? A creditor owed money for operational activity like unpaid supplies, vendor, service provider. For example, a logistic company unpaid for its service. This is example of operational creditor. And the third is corporate debtor. So the corporate debtor can also initiate the CIRP. Corporate debtor. So the company or debtor itself can voluntarily initiate CIRP if it is unable to pay its debt under the voluntary insolvency provision. This is typically done to seek legal protection and work toward resolution. So what about the principal debtor? The principal debtor cannot initiate CIRP on its own unless it is filing as a corporate debtor under voluntary insolvency provisional. So let's suppose, let me give an example. Suppose there is a company named ABC Limited. It owes 5 crore to a bank. Okay, so this bank will be what? This bank will be financial creditor. Suppose it owes 50 lakh to a supplier. Okay, it owes 50 lakh to a supplier, so this supplier will be operational creditor. Suppose in this, let's consider the first scenario. The bank can initiate CIRP as the financial creditor due to unpaid loan. Scenario 2, this particular supplier can also initiate CIRP as an operational creditor due to non-payment of the dues. So this is OC, this is FC, both of them can initiate CIRP, and this corporate debtor can also initiate the CIRP, right? But the principal debtor cannot initiate CIRP unless filing as a corporate debtor. So this process ensures transparency and fairness for all stakeholders involved. Now, so hopefully you have understood this particular concept. Now let's move on to the next question. The next question is, as you can see, yeah, this is a very good question. A company has sales of 24 lakh. I think, yeah, 24 lakh at 200 rupees per unit. The break even point is 50% of the sale, and the profit volume ratio is 25%. You have to find the fixed cost. Okay, sales is given, break even point is given, profit volume ratio is given, and you have to find the fixed cost. So here you should know what is the formula for the profit volume ratio. This question is quite simple. You just have to substitute the value, right? You will get the answer. So what is given? Break even point is 50% of the sale. And how much is the sale? Sale is given 24 lakh. So can you tell me what will be the BEP? So BEP will be 50% of 24 lakh, isn't it? It's 50% of 24 lakh. What will be the 50% 24 lakh? 12 lakh. So BEP will be 12 lakh. Okay, and now PYV ratio is given how much? PYV ratio is given 25%, or we can say 0.25, either 25% or 0.25. Now first of all, you should know the basic formula to compute it. The formula is quite simple, that BEP, break even point, is equal to fixed cost upon PYV ratio. Okay, BEP is equal to fixed cost upon P by V ratio. So what is BEP? You know, let me give you how this formula came. Let me just remind you. So suppose this is our sales. One part of the sales is variable cost, you know very well, and the other part of the sales, this is called contribution, right? This is called contribution, right? And contribution, inside contribution you will get what? You will get two parts. One is the profit and other is the fixed cost. So at, you know, at BEP no profit is there, so contribution will be equal to fixed cost, you know it very well, right? At BEP, the point at which BEP held, there is no contribution, sorry, there is no profit. Okay, so our entire contribution will be borne by the fixed cost. So if we multiply this BEP with P by V ratio, this will give you contribution. That's how this formula came, right? Instead of this contribution, you can write BEP times P by V ratio. BEP is what? Number of units. It is nothing else but number of units, and P by V ratio means profit volume ratio. Okay, so this is how this formula came, and now you just have to substitute the value. Okay, you have to so you can see here in this particular formula, you can see, you can write, just let me erase it. Okay, we have got BEP 12 lakh. Let me erase it, and I will do the calculation, risk calculation here. So so you have to find the FC, right? So FC, you can say it is nothing but BEP multiplied by P by V ratio, isn't it? So what is BEP here? BEP here is 12 lakh, and what is the P by V ratio? It is nothing but 0.25. So you can say 1/4. So what is the 1/4 of 12 lakh, right? So here it is 1/4, or you can say 1/4. I think it is 3 lakh, right? 1/4 is 3 lakh. So the correct answer is 3 lakh. So fixed cost is 3 lakh. Let me see the option which correspond to 3 lakh. So I think no option is given, but let's suppose option number E is there, 3 lakh. So 3 lakh is the correct answer. So let me again summarize the fact which we have learned in this particular question. Break even point is the level of sales at which there is no profit or loss. P by V show the contribution margin as a percentage of the sale. I already told you, it shows you the contribution margin, right? Contribution margin as a percentage of the sale. So that's why P by V, if you multiply with BEP, this will give you the contribution. And fixed cost calculation, use the BEP and P by V ratio, right, to find fixed cost when sales details are provided. So this is how you have to calculate this. Now let's see the next question that we have. The next question is, the limited liability partnership is established under which statute? So very good question. LLP, the question is regarding the LLP. So LLP is established under which statute? Options are Companies Act 2013. Yeah, this is wrong. See, first of all, if you know about limited liability partnership, so this is a unique business structure that combines the advantage of both a corporate structure and well as partnership. You know about it? It combines the advantage of both corporate structure as well as partnership, right? This is a unique feature of this LLP. So it offer limited liability to its partner, meaning their personal assets are protected. That is called limited liability. Okay, unlike in traditional partnership where the partners have unlimited liability. In traditional partnership, you know, the partners have unlimited liability, while in the case of limited liability partnership, their assets are protected. The LLP Act 2008 governed the establishment, management and operation of the LLP in India. So the correct answer will be option number C. The next question is, why other options are incorrect? First option say Companies Act 2013. Say this act governed the incorporation and regulation and dissolution of company, not LLP. So Indian Partnership Act, this act deals with general partnership which does not provide a limited liability feature. And last is Society Registration Act. So this act pertains to the registration of society. So what is the key takeaway from this particular question? We have seen that LLP are governed by the Limited Liability Partnership Act 2008. It combined limited liability with the flexibility of a partnership structure. It is distinct from a company and traditional partnership. Hope that things clear up. Now let's see the next question. What is the green clause LC? Okay, the next question was asked, what is the green clause letter of credit? You have been provided with the four option. Okay. First option say, first of all, let me provide you explanation. A green clause LC is a specific type of LC that allows the exporter to receive advance payment for certain goods, certain cost before the shipment of the goods. Okay, so you will receive the advance payment means exporter. You will not. Exporter will receive the advance payment for a certain goods. Okay, and the advance payment is specifically for storage and processing of goods. You will receive advance payment, but what it is for? It is for the storage plus processing of goods, right, ensuring that exporter had necessary fund to take care of the goods before they are shipped in. This is particularly useful in scenarios where goods need to be stored or processed for significant time before shipment. It happened that in some product we have to store the goods, we have to process the goods for a significant time before shipping them, and for such cases this green clause LC is a superior, plays a fruitful role. Now let's see what are the other option. First option A say that LC that allow advance payment for storage and processing of goods, correct. And LC that restrict parcel shipment, this is wrong, because this describe the red clause LC. You know about red clause LC, which can restrict parcel shipment, not the green clause. An LC that mandate payment only after the final inspection of goods, so this is more aligned with the site letter of credit. Okay, and last option says NLC used exclusively for agriculture purpose. I think green clause LC not restricted to agriculture purpose. So what we have learned in this particular question, that the green clause letter of credit helps the exporter by providing advance payment for storing and processing goods. It reduces the financial risk for exporter, and this type of LC is highly beneficial in cases where goods require extra time for handling before delivery, right. So this is a key fact about the green clause letter of credit. Now let's see the next question. Which of the following best describe an English mortgage? So options are given. You can see four option is there. Option A says that the mortgagor transferred the property conditionally without any personal liability to repay the loan. Option B says that mortgagor bind himself personally to repay the mortgage money on a specific date, and the property is absolutely transferred to the mortgagee with a condition for reconveyance upon repayment. The mortgagor retained full ownership of the property but provide the mortgagee with a lien until repayment. Option D said that mortgagee has right to sell the property without transferring ownership during the loan term. So tell me which statement best describe English mortgage? So first thing, English mortgage is one of the traditional form of mortgage. It is unique in the fact that the first is mortgagor, right. So mortgagor means borrower. So borrower bind himself personally to repay the loan. Borrower binds personally to repay the loan, and the property is absolutely transferred to the mortgagee. Property is transferred to the mortgagee. Who is mortgagee? Mortgagee is lender. Property is transferred to the lender with a condition that property will be reconveyed to the mortgagor once the loan is repaid, and it involves full ownership transfer to the lender, but upon repayment the mortgagor get the property back, right. Now why are the other option incorrect? So let us go to the option. Option A said that the mortgagor transferred the property conditionally without any personal liability to repay the loan. So this describe a conditional sale. It describe a conditional sale, not an English mortgage. In an English mortgage, the mortgagor bind himself personally to repay the loan, right. Option B says that the mortgagor bind himself personally to repay the loan. Correct on specified date, and the property is absolutely transferred to the mortgagee with the condition for reconveyance upon repayment. Yes, correct. This is exactly what English mortgage is all about. Option C says that the mortgagor retain full ownership of the property but provide the mortgagee with lien until repayment. What do you think? See, this is refers to the simple mortgage. See, it is quite essential to see each and every option because other option provide you a concept. So this is the concept of simple mortgage. So suppose question is what is simple mortgage? So this option will be correct. The mortgagor retain the full ownership of the property but provide a mortgagee with lien until repayment. Yes, correct. So in the English mortgage, the mortgagor transfer full ownership to the mortgagee, unlike in simple mortgage where only lien is provided. And last option say mortgagee has a right to sell the property without transferring ownership during the loan terms. So tell me whether it is English mortgage? No. This describes the power of sale clause. It describes the power of sale clause which is typically found in mortgage like the English mortgage, but it does not accurately describe the essence of the English mortgage. So the key feature is transfer of property with the condition of reconveyance. So let us quickly revise what we have learned in this particular question, that in English mortgage, the mortgagor transfer the property to the mortgagee and bind themselves personally to repay the loan, right. And upon repayment, the mortgagor can have the property reconveyed to them. The mortgagee has absolute ownership of the property until the debt is clear, right. So friends, So a bank financial shows the following figure. So bank credit in India is 12,000. I think all the data are in crore, right? All the data are in crore. So 12,000 crore. Then we have bill discounted 1200 crore. Outstanding deposit under RIDF, NABARD, NHB, SIDBI and Mudra 1500 crore. Outstanding PSLC 500 crore. Exemptions on long-term bond for infra and affordable housing. It is 1800 crore. Investment in recapitalization bond, right? Investment in recapitalization bond, it is 400 crore. Advance against incremental FCNRB or NRD deposit 700 crore. Please take a screenshot of this slide because the data we will be using to solving the numerical. This thing will be provided in the examination. Then the next thing is given that investment in securitized asset, as you can see, is 300 crore. Then we have face value of STM security under TLTRO and SLMF, it is 1000 crore, and bond debenture in non-SLR category under STM category 600 crore. Now let's see the question. So this data have been given. I request you to please take a screenshot of it. What is the ANBC of the bank? Right, 4 option has been given. What is the adjusted net bank credit from the bank? So let us calculate each and every step by step. How do you go about calculating it? Right. So friends, let us calculate it step by step. So these data have been given, right? So first of all, you must know that what is the formula for calculating net bank credit. Do you know the formula for calculating net bank credit? So let me write it down. So the formula for calculating net bank credit, NBC is called net bank credit, is equal to bank credit in India minus bill discounted, right? Minus bill discounted. Now please tell me what is the bank credit in India? It is 12,000. So just write 12,000. And what is the bill discounted? It is 1200. So just subtract it, 1200. So this will give you how much? This will give you 1800 crore. Right, 1800 crore. Now think of this is called NBC, net bank credit. Think of this as the bank net lending after excluding the credit it has already sold or rediscounted with other financial institution. Means the bank net lending. You can think of them as the bank net lending after excluding the credit it has already sold or rediscounted with other financial institution. Then what you do? You add the RIDF. You add the RIDF deposit and PSLC. You add these two. Right. So what is RIDF deposit? 1500 crore. What is PSLC? 500 crore. So total will be how much? Total will be 1500 plus 500. So this will give you how much? 2000 crore. Right. So now the new total is how much? New total is 1800 crore plus 2000 crore. So this will be how much? 12,800 crore. Right. Now this is the step number 2. So in step number 2, what we did, we add the RIDF deposit and we add the PSLC. So these two have been added and this has been subtracted. Now after step number 3, that we add exemptions for long-term bond. So bank get exemptions for issuing long-term bond meant for infrastructure and affordable housing. So we will add this. So 12,800 plus how much? Plus 500, right? So no, it is 1800, right? So this is the exemption. So 12,800 plus 1800. So this will give us how much? 14,600 crore, right? Now then what we will do? Then the next point we have is to subtract exemptions and investments, right? So now you can see advance against incremental FCNR and RD deposit. So these are the kind of exemptions which is given. It is how much? 700 crore, right? And this investment in recapitalization bond, this is also kind of investment. So this is 400 crore. And investment in securitized asset is also 300 crore. So if you add all of them, it will amount to 700 plus 300 plus 400. So this will give you how much? It will give you 1400. It will give you 1400. So this you have to deduct. So total deduction is 1400 crore, right? So the new total will be how much? The new total I am writing here 14,600 minus 1400. So this will give us 13,200 crore. So these things have to be subtracted, right? Now HTM security has to be added because which is the face value of held to maturity under TLTRO, SLMF. So you have to add these two, right? So you have to add these two. So you can see the 1000 crore has to be added. So just add 1000 crore. It will become 14,200 crore. Now the final thing is that you have to subtract bond in non-SLR category under STM. So which is how much? 600 crore. So you subtract 600 crore. The final answer is how much?
13,600 crore. Right, so this is how you calculate the A and BC. Now let's analyze each and every option. So first of all, you must know what has to be added, what has to be subtracted. Please take a screenshot of this slide. This will help you know that this thing have to be subtracted and this thing have to be added in order to compute A and BC. And this question is most frequently asked in every CCP examination. Right, so let's go through the option. Option number C is the correct answer. Right, so the correct answer is option number C. So let me summarize before we wrap up. Here are the key points to remember. Right, so there is a formula to calculate A and BC. And what is the formula? Let me show you the formula. Right, so let me write down the formula of A and BC. What to add, what to subtract. So first of all, you calculate the NBC. First of all, you add the NBC. You add it RIDF or PSLC. Then you add the exemptions. Then you subtract the deduction. Then you add the STM security. Add the STM security, and then you subtract the non-SLR bond. Right, so this way you have to compute A and BC. Right, so this is the formula for A and BC. So the key components here are RIDF and PSLC. These are added. Remember, RIDF and PSLC are added. Long-term bond for infra and affordable housing are added at exemptions. So this exemption includes, long-term bond, which is given for infrastructure and affordable housing. And deduction include, advance against FC and RB. So whatever advance has been given against FC and RB, and whatever advance has been given against NRE deposit, recap bond, this has to be deducted. Right, so carefully consider addition and deduction. Missing even one component can lead to incorrect answer. So this is how you have to compute the A and BC. Please remember the formula. This will help you compute it. Now let's see the next question. The question number 2 is on your screen. I request you to please try to solve this question yourself. This question is based on diversion of the fund. Very important question it is. So let's go through each and every option and understand which option is correct one. So friends, let me see you the question. A bank earmarked 100 crore exclusively for priority sector agriculture lending as per the regulatory guideline. During the year, the bank disbursed only 75 crore. Right, only 75 crore was disbursed for agriculture lending, while the remaining 25 crore, was allocated to corporate non-priority lending. Now we are asked, what is the amount representing the diversion of fund? 0 crore, 25 crore, 75 crore, 100 crore. So first of all, what you must understand, what is the meaning of this term earmarking, right? So first let's clarify what is the meaning of earmarking of fund. The bank set aside 100 crore specifically for priority sector lending in agriculture. Think of it like allocating a monthly budget of rupees 10,000 for grocery. You expect to expend the entire amount only on food item. Now, however, the bank only lent rupees 75 crore to the agriculture, meaning rupees 25 crore is not used for the intended purpose. Instead, this 25 crore is diverted to non-priority lending, which is a corporate lending, which is a non-priority sector. It's like you plan rupees 10,000 for grocery, but only 7,500 on food, but only spend 7,500 on food and remaining 2,500 for online shopping. So can you tell me what is the diversion? So obviously the diversion which has been asked to you is how much? So diversion is equal to 100 crore which was earmarked and minus 75 crore. Minus 75 crore. What is 75 crore? Because this 75 crore is the actual disbursement. So this was the earmarked amount. This is the actual disbursement. The answer is 25 crore. Right. So let's go through each and every option. So option number B is the correct answer. Right. So what we learned from this discussion, that earmarking of fund, whenever bank reserve money for a specific purpose, it should be used only for that purpose. Right, and diversion formula is quite simple. What you have to do, you have to subtract earmarked fund and actual disbursement. This will give you the diversion, right? So that is our answer. Very easy question it was. Right, friends, if you are preparing for CCB and if you are looking for study material for the same, so let me show you a study material on my app JIB and CIB Made Simple. I have made a course in which you can see that I have added 3 previous year questions. Right, so you can see this is how the course look like. Friends, offer module wise, module A, module B, module C, module D and module E. If you open a single module, like suppose I open module A, so there are different unit in module A, like unit 1 principle of lending, unit 2 credit policy, and inside each every unit you will get separate theory PDF and separate MCQs PDF. Like suppose I open module unit 1, so you will get separate theory PDF and MCQ PDF. So friends, this way it has been arranged. So if you want to get access to such kind of material, you can WhatsApp me on this particular number I am writing on the screen. right? And you can also join our Telegram channel, in which different candidates have already joined, and they pose the memory based question. The description of the Telegram channel is provided in the description section of this particular video, right? Now let's see the next question. The next question is on your screen. As you can see, this is a very important question. Let's go through it. So friends, the question asks that an exporter has received a PCFC facility. You know PCFC? That is called pre-shipment credit in foreign currency. Exporter has received a PCFC facility from a bank with the following condition. The facility offer competitive rate linked to LIBOR, Euro LIBOR or Euri LIBOR. Exporter can choose to avail of PC in rupees or directly in foreign currency, right? Cross currency PCFC is allowed, right? Cross currency PCFC is allowed, and the PCFC is carved out of the normal PC limit. So let's see the question directly. No need to go through each and every option. Which of the following statements regarding this PCFC facility is not correct? Right. Option number A. Exporter can avail of PCFC in one convertible currency for an export order invoice in other convertible currency, although the risk of cross currency transaction is borne by exporter. Option number B. The PCFC facility is subjected to separate limit apart from the normal PC limit sanctioned by the bank. The option number C, the rate of interest on the PCFC should not exceed 350 basis point over the applicable LIBOR. And option number D, for non-standard credit period, the applicable rate of interest is determined by using the rate for the next order for a standard period. So friends, these are the four options, and which is not correct have been asked. So let's go through each and every option. So friends, you know what is PCFC? So basically, let me explain a little bit about the option. So first of all, let's understand what is PCFC basically. So PCFC stands for pre-shipment credit in foreign currency, right? It is a loan facility given to exporter to, so it is a loan facility given to whom? To exporter, right? It is a loan which is given to exporter to finance their working capital need, right? To finance their working capital need, like buying raw material, processing, packaging before shipping the goods. So instead of taking a loan in rupees, exporter can avail in foreign currency, right? So that is why FC word is written there, foreign currency like dollar, euro, Great Britain pound. Why? Because foreign currency loan have a lower interest rate, making them cheaper for exporter. And interest rate are linked to LIBOR, which is London Interbank Offer Rate or Euri LIBOR. Now let's analyze each and every option one by one. So first of all, let's go through option number B. It says that PCFC facility is subjected to separate limit apart from the normal PC limit. Under the PCFC scheme, there are no separate limits. So this option is wrong. This facility is carved out of the bank existing PC limit sanctioned to the exporter. It's like having a single wallet for shopping, whether you pay in cash or you pay in card. You are spending from the same wallet. Similarly, PCFC is not an additional limit. It comes out of the already approved pre-shipment credit limit. Hence, this is incorrect option. Right. Option number A. Exporter can avail of PCFC in one convertible currency for an export order. Yes, correct. Because in cross currency PCFC, there is a kind of called cross currency PCFC. So in cross currency PCFC, exporter can borrow in one currency, let's say dollar, even if the export order is invoiced in other currency, let's say euro. However, exporter bear the currency risk, which means if the exchange rate fluctuates unfavorably, the exporter may incur a loss. So let me give you an example to make it more clear. For example, suppose you take PCFC loan in dollar, right, for an export order which is invoiced in this export order is invoiced in suppose euro, right? So if the USD is strengthened against dollar, suppose US dollar is strengthened against euro, right? So by the time you receive the export proceed, you will end up receiving fewer dollar when converted, reducing your earning. So this option A is correct. Option C says the rate of interest should not exceed 350 basis point over the applicable LIBOR. Yes, this is also correct. Because under PCFC scheme, the maximum interest rate that bank can charge is 350 basis point above LIBOR. So what is the meaning of basis point? So 1 BPS, 1 BPS is equal to 0.01%. So here 350 BPS means 3.5%. Right? So option C is correct. So A is correct, C is correct, B is wrong. And option number D says that for non-standardized credit period, the applicable rate of interest is determined by using rate for the next. Yes, this is also correct. Bank offer PCFC loan for a standard tenor. There is something called a standard tenor. 1 month, 2 month, 3 month, 6 month or 12 month. These are the standard tenor. For non-standard period, let's say 4 month. Suppose 4 months. So this 4 month is not a standard period. For non-standard period, the interest rate of the next higher standard period is charged. So let me give you an example to make option D more clear. Let's say that you have availed PCFC for 4 months, right? So the bank will apply the interest rate for 6 months, which is the next higher period. Understood? So option D is correct. So the correct option to this question is option number B, not correct have been asked, right? So what we learned from the discussion is that the key learning from this discussion is that PCFC, first thing is that PCFC is a pre-shipment credit, first thing, right, for exporter. So for first point you must make it clear that this is the kind of pre-shipment credit, right, and it is offered in foreign currency, and it is linked to the LIBOR or Euro LIBOR. Second point, cross currency PCFC is allowed, but the exporter bear the exchange rate risk. Interest rate on PCFC cannot exceed 350 basis point, and no separate limit are required for PCFC. It is carved out of the normal pre-shipment credit limit, and for non-standard tenor, bank apply the interest rate for the next higher standard period. If you find this concept helpful, if they find the video helpful till now, please hit the like button, right? This will motivate me to make more such and such content, right? So now option B is correct to this particular question. Now let's see the next question on gold card scheme. This question is most frequently asked, right? So let's go through the question. So some statement has been provided to you, right? So friends, the gold card scheme, option number A says that it was introduced by RBI, right? So so some statements are there. Statement number 1, eligibility. Only exporter with a minimum track record of 3 years who have continuously maintained a standard performance with no irregularity are eligible for gold card. Statement number 2, gold card holder are given preference by bank for granting packing credit in foreign currency and may also be considered for term loan in foreign currency using FCNR fund. Statement number 3, the in principle credit limit is sanctioned for a period of 3 years and is automatically renewable provided the exporter comply with the loan term. Statement number 4, processing charge on loan for gold card holder are lower than those for other exporter, and a flat service charge of 0.1% is applied on interbank foreign currency borrowing. And statement number 5, that a standby limit of not less than 20% of the assets limit is available for urgent credit need, right? So these are the 5 statements. Now which combination of statement is correct? So in this question we will able to cover every part of gold card scheme. So which statement is correct? A statement option number A, 1, 2, 3 and 5, 4 is incorrect. 1, 2, 3 and 5. So I think yes, so it's easy. 1, 2, 3 and 5 are correct, 4 is incorrect. 1, 2, 3, 5 are incorrect, 4 is correct, right? And only 1 and 2 are correct. All statements are correct. So these are the 4 options which is given. So now let's go through each and every statement. So friends, gold card scheme is an RBI initiative, first thing, right? And it is a priority financing and lower charge to the exporter. It offers priority financing and the lower charge to the exporter, right? And it is faster loan processing and longer credit validity. So you can think of like a VIP membership for exporter where they get faster service, better rate. Now let's analyze each statement. So first statement says that only exporter with minimum track record of 3 years, right? This statement is correct. Right, to be eligible for gold card, you must know that it should have a clean track record. It should have a clean track record of 3 years, right? At least 3 years, and there should be no default, no irregularity. So exporter who are blacklisted by ECGC, right, or on the RBI defaulted list or incurring loss for 3 consecutive years are not eligible. Very good, it is correct. For example, imagine you run an export business and have been regularly repaying loan on time for past 3 years. So you qualify for gold card. But if you have defaulted or made losses in the last 3 years, then you won't be eligible. So this is the point. Now let's look at statement number 2, credit preference and flexibility. So this statement is also correct because the gold card holder get preferential treatment from bank, meaning they are given priority for packing credit in foreign currency PCFC. Yes, they get priority. Right, they get priority in PCFC, and also bank may grant them term loan in FC, right, using FCNR fund, and the loan limit is based on their expected export turnover, making it more flexible. So if you are a gold card holder and you apply for foreign currency loan, the bank will prioritize your application over non-gold card holder. So this is also correct. Now statement 3. So under the gold card scheme, the bank sanctioned a credit limit for 3 years. This is correct, right? And if the exporter follow the loan terms, the limit is automatically renewed. The limit is automatically renewed without the need for reapproval. So suppose, let me give you an example. Suppose you are an exporter with gold card and sanction limit of 10 crore, right, for 3 years. So if you repay on time, if you repay the amount on time and follow the rule, the bank will automatically extend the limit without additional paperwork. So this is also correct. Till now we have seen 1, 2, 3 are correct. What about option number, statement number 4? So this is also correct. It says that gold card scheme offer a standby limit of at least 20% of the access limit for urgent card need. Yes, correct. So loan processing is faster for gold card. 25 days for new loan proposal, 15 days for renewal, and 7 days for ad hoc treatment. So if you need urgent loan of 50 lakh, the bank will process your application within 7 days instead of the usual timeline. So this is also correct. Now let's look at the statement number 4. This charges is incorrect. This statement like charge is incorrect. Why? Because while it is true that gold card holder enjoy a low processing charge, the 0.1% flat service charge is incorrect. Right? There is no specific 0.1% flat charge. Right? So the correct answer is 1, 2, 3 and 5 are correct and 4 is incorrect. So option number A is correct here. Right? So friends, what we learned from this discussion is that eligibility. So let me summarize the fact regarding this gold card scheme. Let me summarize. So friends, first of all, what we come to know that eligibility. So for eligibility, the requirement is that 3-year track record, right, of clean performance. Defaulter and loss maker are not allowed. Then we talked about the credit benefit. Yes, there is a priority processing for loan, faster approval and automatic renewal of limit. And then we talked about the standby credit. So at least 20% of the limit, remember, at least 20% of the assets limit is kept aside for urgent need. Then we talked about faster processing. So I talked about 25 days for new proposal, 15 days for renewable and 7 days for ad hoc limit. So friends, if you find this explanation helpful, please hit that like button. Right. So I will prepare more such kind of videos. Now let's look at the MSME scheme. This question is most frequently asked. Right. Let's try to understand the question. So friends, as per the revised definition of MSME under the Atmanirbhar Bharat Abhiyan, which of the following correctly represent the classification criteria for medium enterprise? Option A, investment in plant and machinery less than 1 crore, turnover less than 5 crore. B, less than 10 crore, investment, turnover less than 50 crore. C, investment less than 50 crore, turnover less than 250 crore. And D, investment less than 20 crore, turnover less than 100 crore. So friends, MSME is classified based on two categories, investment and turnover. So when I say investment, what it means? Investment means, in plant, machinery or equipment. Turnover means the annual revenue of the enterprise. So let me tell you the revised criteria. So basically, I will tell you the revised criteria of MSME. So what I do, I will prepare these two timeline, right? So this is investment and this is turnover, right? So first of all, micro, small, medium, right? So for micro enterprise, it is 1 crore. Just write here 1 crore, right? Just write here 10 crore. And just write here 50 crore. This is the way to remember it. And just multiply it by 5. So this is how much? 5 crore. Just multiply it by 5. This is how much? 50 crore. Just multiply it by 5. This is how much? 250. So 1, 10, 50 and then multiplied by 5. So this region is for micro. This region is for small. And this region is for medium. Now you can easily remember it. No need to memorize anything, right? So basically for micro enterprise, investment limit is 1 crore, turnover limit is 5 crore. For small enterprise, investment limit is 1 to 10 crore and turnover limit is 5 to 50 crore. And for medium enterprise, for medium enterprise, it is investment limit is 10 to 50 crore and turnover limit is 52 to 50 crore, right? So let's go through each and every option, right? So which option is correct? Can you tell me? Yes, option B is correct. 10 for medium we are talking about, right? No, it is not correct. I think option C is correct, right? Yes, option not B, option C is correct, because investment less than 50 crore and turnover less than 250 crore. This is the correct answer. So imagine that you run an IT company with investment in server, equipment, infrastructure. Suppose your investment is 45 crore and your annual turnover is suppose 200 crore. So your company will be classified as medium enterprise, right? So that is the correct answer. So friends, I hope that makes sense to you. So remember this limit. This is quite easy to remember. Just remember this word: 1 crore, 10 crore, 50 crore. 1, 10, 50, 1, 10, 50. Write it down many times. You will be able to remember it. And just multiply it by 5. The lower limit will also be clear to you. Right? So 1, 10, 50. Just we have to remember it. Now let's see the next question. The next question we have. This is a very good question. This asks you to calculate the cash accrual. Right? This question is asked in the examination, which is asked in 8 March examination, which I recently conducted. So a company financial for the year shows the following detail. Some detail has been provided to you. As you can see, net profit after tax 50 lakh, depreciation 10 lakh, amortization of intangible asset 5 lakh, interest on long term loan 8 lakh, provision for tax 7 lakh, dividend payout is 4 lakh. What will be the cash accrual? So before we jump into the solution, let's first understand what is the meaning of cash accrual. Cash accrual, it means net cash inflow generated by the company from its operation. It shows how much cash the business actually generate, excluding non-cash item. So cash accrual, the formula is the formula for cash accrual is NPAT, net profit after tax. Then you add non-cash expense. Let me write down the formula first. Then you add what? Non-cash expense. right? So NPAT plus non-cash expense plus plus interest on long-term loan plus interest on long-term loan, right? So this is how we use. So now non-cash expense, so here you will see a term called non-cash expense. So what is the meaning of non-cash expense? So non-cash expense include depreciation. So depreciation is a kind of non-cash expense. Why? Because because it reduces the profit on paper but does not involve actual cash outflow. Does depreciation involve actual cash outflow? No. Yes, but it reduces the profit on the paper. Another kind of non-cash outflow, non-cash expense, is called amortization. Right? What is amortization? Same as depreciation, but for intangible asset like patent or trademark, this is called amortization. Right? So remember, tax provision and dividend are not included in the cash accrual. Remember this thing, very very important. Tax payment and this dividend, right? They are not included in cash accrual. Why they are not included? Because tax provision are estimated future liability, right? Not actual cash outflow. So tax provision, they are estimated future liability, not cash outflow, and dividend payout represent a distribution of profit, not an operational expense. So that is why these two things are not included in the cash outflow. Remember it, depreciation will be included as non-cash expense. Yes, it is a kind of non-cash expense. And amortization on intangible asset, this is also kind of non-cash expense. And interest, obviously, since you have taken long-term loan, so this is a kind of net cash outflow, right? So this is cash accrual. So friends, now let's do a step-by-step calculation. So here we have NPAT is how much? NPAT is just let me erase the some area. Just wait a minute. So let me erase it. Now let's apply the formula here. So NPAT is how much? NPAT is 50 lakh plus depreciation is how much? 10 lakh plus amortization is how much? 5 lakh plus interest on LTL is how much? 8 lakh. So after adding these two, this will give you 73 lakh. So this is the net cash accrual, right? What are the options? 68 lakh, 80 lakh, 75 lakh, and I think 73 will be correct answer, right? So which option do you think is correct here? So the correct answer will be 73 lakh. Yes, so I think let us say instead of the 75, let's say this is 73. So this is the correct answer, 73 lakh. Right. So remember, what we have to remember is that cash accrual, the formula is NPAT plus depreciation plus amortization plus interest on long-term loan. Right. What to include? Non-cash expense and interest on long-term loan to include. And what to exclude? What to exclude here? So to exclude, we have provision for tax and dividend payout. Right. So this is how you should remember it. Now let's see the next question. So I hope that makes sense to you. Now let's see the next question that we have. The next question is so PMEGP, that is called Prime Minister Employment Generation Program, very very important concept. So friends, let's talk about this particular concept. So which of the following statement regarding PMEGP is correct? Option number A says that it is a kind of a central sector scheme, right? So it says that it is a kind of central sector scheme administered by the MSME and implemented at the state level by the KVIC in rural area and DIC in the urban area. Option number B, the maximum project cost allowed under PMEGP is 50 lakh for the manufacturing sector and 25 lakh for the service sector. Option C, PMEGP allow funding for both new and existing project, including retail, trading and business across all region, right? And option D, generation program. It is a central sector scheme introduced by Ministry of MSME, and the objective of this scheme is to generate self-employment and to promote micro enterprise in the rural and urban area, right? So it provides subsidy based loan for new project. It focus on manufacturing and service sector, and it offers a special benefit for northeast region, left-wing extremist affected district and Andaman and Nicobar Island. So option number A suggests that it is a central sector scheme. Yes, it is correct, because it is indeed a central sector scheme and it is introduced by Ministry of MSME, right? At state level, it is implementation is done by the in rural area KVIC and KVIB. Sometimes KVIB is also there, which is State Khadi and Village Industry, or DICs, right? And DICs in the urban area. In urban area, only DICs. So for example, imagine a person in rural village want to start a handloom weaving business under PMEGP. So they will apply through KVIC or KVIB for financial support. Whereas in urban area, someone starting a small cafe will apply through the DIC. Option A is correct. Option B suggests that the maximum project cost under PMEGP is 50 lakh. So this is wrong, because the under PMEGP the maximum project cost is actually 25 lakh, It is 25 lakh for manufacturing sector and 10 lakh for the service sector. So suppose you plan to start a small garment manufacturing unit, so you can get funding up to 25 lakh under PMEGP. If you want to open a service business like a saloon, the maximum funding is 10 lakh. Now option number C, PMEGP allow funding for both new and existing project. This is also incorrect. PMEGP only fund new project, it does not fund the existing project. So retail trading is not allowed nationwide. It is only permitted to a special. You can see including retail trading. No, retail trading is not allowed nationwide. It is only permitted to a special region like Northeast region, or suppose LWE, left west extremist affected region, and Andaman and Nicobar Island. So in other region, retail outlet are allowed only if they are backed by manufacturing or service facility. Let's say you want to open a stationery shop. If you are in Northeast region or LWE region, you may be eligible. However, in regular city, you won't qualify unless your business involve both trading and manufacturing service activity. So that's why option number C is incorrect. Now, next option is, under PMEGP, capital expenditure is not mandatory. This is also wrong, because capital expenditure is mandatory. You must invest in asset like equipment, machinery to avail of the loan. Trading activities are not involved, right? So you can see trading activities are permitted. No, this is wrong. Trading activity are not permitted. Remember it. Right, so they are restricted to NER LWE district. So suppose you are in NER region and you can avail of PMEGP funding if you want to open a grocery store. But if you are in metro city like Delhi and Mumbai, you won't qualify unless you are also have a manufacturing service unit alongside the trading activity. So the correct answer to this question is option number A. Right, option number A is the correct answer. Just now we have seen it. Yes, this is the correct answer. So what we have learned from this question regarding the PMEGP, that it is, first thing is that it is a central sector scheme, first point. Second point is that administered by MSME. Third point is that implemented in state level by KVIC and KVIB, and in urban area by DICs, and maximum project costing for manufacturing sector is 25 lakh and for service sector is 10 lakh, right? And retail trading is restricted to a specific region, and capital expenditure is mandatory to avail the loan. So if your concept is clear, please hit the like button, right? So I have explained each and every point regarding the PMEGP. This question is most frequently asked, right? Now let's shift our focus, right? So remember, the key way to remember, the trick to remember is that this PMEGP, Pradhan Mantri Employment Guarantee Program, is restricted to new project only, right? It is restricted to new project, and capital expenditure, capex, is mandatory. And trading is allowed in restricted region. Trading is allowed in restricted region. That is a point. So it is for new project, capex is allowed, and trading is allowed in the restricted region. The 3 point you must remember it, right? Now let's look at the consortium advance. This is a very good question. So friends, the question is, which of the following statement regarding consortium advance is correct? Option A, consortium financing is required when the loan amount is large and beyond the prudential exposure norm. Option B, a company with multiple division or multi-product operation is always treated as separate unit by different bank. Option C, under a consortium arrangement, only one bank participates in financing the borrower, right, while the other financing institution act like guarantor. Option D, in consortium, each participating bank provide finance to the borrower independently without coordinating with other bank involved. So what do you think regarding consortium arrangement is correct? So consortium banking is when 2 or more bank or financial institution come together to jointly provide a loan to a borrower. When this is done, so whenever borrower need a large loan, right, then they can go for consortium, and such a loan exceeding the lending limit of a single bank. If it exceeds the lending limit, there are limit which is placed by RBI. So if such loan, if it exceeds the lending limit of a bank, then it is done. So this reduces the exposure for each individual bank. So the borrower deals with only one lead bank. There is a concept of lead bank here, and all the bank involved share the risk. So now let's go through each and every step by step option. So option number A says that required when loan amount. This statement is correct, because this prudential exposure norm are guidelines set by RBI to limit the maximum loan amount a bank can give to a single borrower. So if a company require a loan larger than this limit, no single bank can fund it alone. So therefore multiple banks form a consortium to jointly lend the required amount, right? So for example, suppose company ABC need a loan of 500 crore, right? He need a loan of 500 crore to expand its business. So bank X has a lending limit of only 200 crore, right? So instead of rejecting the loan, bank X form a consortium with bank Y and bank Z, right? Together they jointly provide the 500 crore loan. So that's why option number A is correct. Option B, this statement is incorrect, because a company with multiple division or or product or multi-product is generally treated as one single unit if it has only one published balance sheet, right? It is treated as a separate, it is treated as a single unit. So bank cannot treat different division as separate entity unless they have separate financial statement. So without separate balance sheet, bank must form a consortium for a large loan. Let me give you an example to make it more clear. For example, let's say XYZ Limited, this is a company, it has three division. The first division, let's say the textile division. The second division, let's say the electronic division. The third division, let's say the pharma division. It has the three division. Okay. Now, however, XYZ Limited publish one combined balance sheet, right? It just published one balance sheet. One balance sheet is published by it. Even if different bank want to finance separate division, they cannot treat them as separate entity. So therefore, they must form a consortium to jointly provide the loan. That is why this option is incorrect, right? Now let's see the option number C. Option number C says that under a consortium arrangement, only one bank participate in financing the borrower. This is also incorrect because consortium financing, what happened? All bank involved contribute fund proportionally. No bank acts like a guarantor. Every participating bank lend money to the borrower. So no bank act like a guarantor. Remember it. There is no concept of guarantor here. So that is why this option is incorrect. So let me give you an example to make it more clear. For example, suppose three banks are there, A, B, C. They form a consortium to provide a 300 crore loan, right? So bank A might contribute 100 crore, bank B provides 120 crore, or bank C provide 80 crore, right? So all the three bank lend money rather than acting like guarantor. So this is also incorrect. And what about option number D? We will understand each and every option. So option number D says that in consortium, each participant bank provide finance to the borrower independently without coordinating. This is also incorrect because bank don't lend independently. They work together under joint agreement, sharing the loan amount proportionally. And the borrower deals with a lead bank, right? So there is a concept of so-called lead bank. So the borrower deals with the lead bank, right? For example, suppose this company ABC, they takes a 500 crore loan, right? So three bank, X bank, Y bank and Z bank, the three bank participate. So bank X can act like a lead bank. So this bank X can act like a lead bank and they will manage the overall process. So I hope the concept of consortium is correct. Now the correct answer to this particular question is, option number A is the correct answer. So I have explained each and every option. So if you want such kind of PDF, you can go for our CCP online course, which is available. Many candidates have already passed the examination, reading through the material. You can also join it. The link is provided in the description section. Now let's see a very important question regarding calculation of net cash flow from operating activity using the indirect method. This is a very good question. So friends, let me show you the question. So XYZ Corporation, right, provide the following financial detail. Net income $1 lakh, depreciation expense $10,000, increase in account receivable $5,000, decrease in account payable $3,000. You need to calculate the net cash flow from operating activity using the indirect method. So friends, before we dive into the calculation, let me quickly explain what is the meaning of this indirect method. The indirect method is used to calculate cash flow from operating activity by starting with net income. So you start with the net income, right, and adjust for non-cash expense. I think are familiar with this term non-cash expense. We have already talked about it in the previous question. And then also you adjust for change in working capital, change in WC. So let's calculate the non-cash expense for the net cash flow from operating activity using the detail provided. So you start with the net income, which is how much? 1 lakh. Now you add the non-cash expense. So depreciation is a kind of non-cash expense, so you add it. So it will become plus 10,000. And then depreciation is a non-cash expense, which means it reduces the net income for accounting purpose, but does not involve an actual cash outflow. Does it involve actual cash outflow? No, but it reduces the net income for accounting purpose. So that is why we add it back to the cash flow, right? Try to understand what I am telling you. This is a kind of non-cash expense because this depreciation, it reduces net income. The net income get reduced because of depreciation, right, for accounting purpose, but does not involve. So there is a no cash outflow. Since there is a no cash outflow, so that is why we add it, right? Accounting purpose is reduce it, but is not a kind of cash outflow. That is why we add it, and we adjust for change in the working capital. Now see, there are two things. Account receivable is increasing, account payable is decreasing. So whenever account receivable increase, it means the company has made sale but has not yet collected the cash. That is the meaning of account receivable. So therefore it reduces. Try to understand what will be the impact of the increase in account receivable. Try to understand what will be the impact of increase in account receivable. What is the meaning of account receivable? That means company has made the sale but has not collected the payment yet, right? it has made the sale but had not collected the payment yet, right? So that is the account receivable. That is the meaning of account receivable. So it reduces the cash flow. This account receivable, it reduces the cash flow. Why? Because the company has made the sale but has not collected the cash, right? So till now what we have this 1 lakh. From that we added this 10,000. Why we have added the 10,000? Because we have added the 10,000 since this depreciation expense is a kind of non-cash expense, right? So it reduces our net income for accounting purpose but does not involve an actual cash outflow. That is why we add it back to the cash flow. And so if we talk about the increase in account receivable, it means the company had made the sale but has not collected the cash. So ultimately what it does, it reduces the cash flow. So that is why we have subtracted this 5,000. It reduces the cash flow. Now what about the decrease in account payable? So when account payable decrease, it means the company has paid off some of its liability. So this results in cash outflow, reducing the cash flow, right? So ultimately this will also be subtracted, right? So that is the point. So ultimately after doing the calculation, you will get how much? 1,02,000, right? So that is why option number C is the correct answer. So that is why option number C is the correct answer. So what we learned from this discussion is that cash flow from operating activity involves starting with net income, adding back non-cash expense like depreciation and amortization, right? And adjusting for change in the working capital like increase in receivable, it will reduce your screen. Let me skip this question and let's see this particular question. This is a very good question regarding this letter of credit. Yes, let's try this question, right? So the question is saying that let's try to solve this particular question. This is regarding LC limit. This question is most frequently asked and very, very important from examination point of view. So friends, let me show you the question. A company has the following detail: annual raw material consumption. So you can see annual raw material consumption is how much? 6 crore, right? Economic order quantity is 1 crore, right? Lead time for delivery is 10 days. Transit time is 20 days. Usance period is 6 months. So question is, what will be the LC limit for the company? So before solving the question, let me explain the limit. What is the meaning of LC limit? This is the maximum amount of credit the bank allow for company to open LC for import. So suppose some company want to open LC for import. What is the maximum amount of credit that bank can allow? And the second thing we have is the economic order quantity. So this is the optimal quantity of company order to minimize total inventory cost. In this case, EOQ is 1 crore. What is the meaning of usance period? What is the meaning of usance period? So it simply means the credit period the supplier grant before payment is due. So here it is 6 months. So this is the credit period that supplier grant before the payment is due. And the lead time, lead time is the time it takes the supplier to process and dispatch the order, which is 10 days. And transit time is, that this is the time for goods to arrive at the company location. Now, first we need to find out. So let's go step by step. We have to calculate the LC limit. So the options have been given. So let me show you the options. So these are the four options: 1 crore, 3 crore, 4 crore, 7 crore. So let's solve this step by step. First we need to find out how long an LC remain active from the time of order until payment. So this is the time of order, right? And this is the time of payment. So question is, how long LC remain active? So calculating the duration LC remain outstanding. So how to find it? So it is, you have to just add the time. You take LT, you add transit, and finally you add the usance period. So add all of them. So how much it is? 10 plus 20 plus 6 months or plus 180, which is how much? 210 days. So this 210 days is approximately 7 months. So basically this means LC remain outstanding for 210 days. This is the step number 1. You have to find how much time LC remain outstanding. Second thing what you have to do is to determine the LC frequency. Second thing, you have to find the LC frequency. How to go about finding the LC frequency? So friends, LC frequency is very easy to understand. So let's determine how frequently the company open LC. So you can see annual raw material consumption is how much? Is 6 crore. Economic order quantity is how much? 1 crore. So number of LC per year, try to understand. Number of LC per year is how much? It is nothing but 6 upon 1, which means 6 LC annually. 6 LC is open annually. So since the company uses 6 LC in a year, the frequency, what will be the frequency of opening LC? So frequency will be how much? It will be 12 months divided by 6. This will be how much? 2 months per LC. 2 months per LC is the frequency. This means company open a new LC after every 2 months. Now, so this is step number 3 that we have calculated. Right. So friends, till now we have seen three steps, right? In step number one, we calculate the number of period for which LC remain outstanding. In step number two, we calculate the duration. Then we calculate the LC frequency, which is how much, 2 months per LC. Now then we determine the number of LC outstanding at any time. How many LC will remain outstanding at any particular time? So total LC outstanding period is how much? Total LC outstanding period is 210 days, right? And the company open a new LC every 2 months. So the number of LC outstanding at any time will be 7 months divided by 2 months per LC, which is approximately 3.5, or we can say 4 LC by rounding it off. So therefore company will have 4 LC outstanding at any time. And final step we have to calculate the LC limit. Finally we will calculate the LC limit. How we calculate the LC limit? So now we know that there will be 4 LC outstanding at a particular time. So LC limit, the formula for calculating the LC limit is very easy. That you find number of LC outstanding multiplied by LC amount per order, multiplied by LC amount per order, right? So how many number of LC outstanding? 4 LC outstanding. What is the LC amount per order? 1 crore. So it will be how much? 4 crore. So the company need LC limit of 4 crore. So answer will be 4 crore, right? So how to go about finding the answer to this question? Let me explain once more. First thing to do is to find LC outstanding period. In this case, this is 7 months. Second step, you have to find number of LC per year. Number of LC per year. In this case, how to find it? You take the annual consumption, you divide it by EOQ. This will give you number LC per year. In this case, it is 6 LC. Then you have to find the frequency of LC, right? Then you have to find frequency. You divide 12 by number of LC. So friends, how to find frequency? Divide 12 by number of LC opened, right? Number of LC per year, this will give you frequency. After finding frequency, you have to find number of outstanding LC. How to find number of outstanding LC? Just divide this LC outstanding period.
So now let's get started. Let's see the type of question that have been asked in the examination. So the first question is on your screen, and it asks you that a company has total current asset of 380 lakh, right, and total current liabilities which exclude bank borrowing of 110 lakh. If the projected net working capital is 30 lakh, what will be its MPVF? Under method number 2, clearly written method number 2, what will be the maximum permissible bank finance? So this is also called Tandon committee method number 2, which says that Tandon committee method number 2, which says that first of all we have to calculate the working capital gap. So these are the options. You pause the video, try to solve it on your own, and then see the explanation. Now let me explain. I hope you have done that. Now friends, the correct answer is option number C. Let me explain how to go about solving this problem. First of all, we calculate the working capital gap. What is working capital gap? It is the difference between total current asset and total current liability other than bank borrowing. In this case, we have 380. We have 380 lakh as the current asset, and current liability excluding bank borrowing is 110 lakh. So 380 minus 110, how much it will be? 270, right? So you can think of it like this. Suppose the company need 380 rupees worth of raw material stock, but it already owe 110 to supplier. So the actual gap or the actual shortfall is 270 lakh. So suppose the company need 380 lakh worth of raw material, stock, etc., but it already owe 110 to supplier. That is the meaning of current liability, right? So that is a kind of liability. Asset is 380, it needs use of fund, source of fund, right? So the gap is actually 270 lakh. That is where the bank steps in to help, because this total current liability indicates that what are the liability that it has to pay. So like suppose it owes some amount to someone like 110, right? So so to fulfill this gap of 270 lakh, the bank will step in. The second step after calculating the working capital gap is to deduct the borrower contribution. So what is the borrower contribution? So under method number 2, it says that borrower is required to bring some of their own money, either 25% of their current asset or projected net working capital, whichever is higher. So what is the 25% of the current asset? So total current asset is 380 lakh. 1/4 of 380 lakh is 95 lakh, and projected net working capital is only 30 lakh. So which is higher? 95 lakh is higher. As you can see the calculation, 25% of CA 95 lakh, projected NWC is 30 lakh. So which is higher? 95 lakh is higher. So we will take 95 lakh. This is the amount that borrower has to contribute from their long-term fund,
right? Now third step is to calculate the MPBF. So see, bank will say I have to fulfill this gap of 270 lakh, right? Out of which 95 lakh will be contributed by you. The rest amount I will contribute. So 270 minus 95, which is equal to how much? 175 lakh. So 175 lakh will be the contributed by the borrower. Now let's see the option that we have. The first option say 270 lakh. No, this is wrong. Option number B say basically 270 lakh. Why it is wrong? Because that is the WCG, but the bank won't finance the entire gap. Borrower must bring some margin, right? What about 185 lakh? It is close but incorrect. This might confuse you if you use projected NWC. In the case if you use projected NWC, then you will get this answer. But this is wrong, right? Then the correct answer is 185 lakh. Yes, this is correct. So let's summarize the fact which we learned from this question is that first of all we will calculate the WCG. WCG means current asset minus current liability, and current liability should not include the bank borrowing. And under method 2, bank give MPBF is equal to WCG minus higher of 25% of CA, right? So that is the point. I hope it is clear now. Now let's see the question number 2. So question number 2 is, which of the following is considered the foremost principle of lending that the banker must prioritize before disbursing loan? Very important. Principle of lending question it is. Foremost. So let's understand the correct answer first. First of all, try it yourself. The correct answer is option number C, that is called safety. This is the most important principle in lending. Why? Because the bank is lending public money, that is your deposit, my deposit. So the first responsibility of a banker is to ensure that money will come back safely. Think of it like this. If you lend money to a friend, what do you care about first? Not how much interest he will pay, but whether he will return your money safely, right? Same logic apply to the bank. Now let's understand why other options are not the foremost. Option A, liquidity. Yes, liquidity is very important. It is also one of the principle of lending. It means the banks would be able to get back the money quickly in case of urgent need. But for example, giving short-term loan or loan backed by asset that can be sold quickly. But safety come first. If a loan is a liquid but risky, it is still not good. What about profitability? See, bank is a business. They need to make profit, but profit should not come at the cost of losing the loan amount. First safety, then liquidity, then profitability. That is the order. And lastly, diversification. That means not putting all egg in one basket, like lending to different industry or different people. You know, it is a way to reduce the risk, but again, it is a supporting strategy. Even diversified loan must be safe first. So to summarize the fact, safety is the first principle in lending. Banker must ensure that borrower is trustworthy and can repay the loan. Liquidity, profitability, diversification, these are also important, but they come after safety, right? So remember, a loan is only useful if it comes back. Friends, if you are looking for such kind of previous year question, theory, unit wise theory bullet points and MCQs based on each and every unit as prescribed by the IIBF, then we have a course on CCP available on our app. App name is JIB and CIB Made Simple. The link of app is provided in the description section of the video, or you can WhatsApp me on the number shown in the description. You will get the entire content, and many people have passed the examination using the content. Now friends, have a look at the next question. The next question is, what is the maximum default amount for an MSME to be eligible for PIRP? That is called prepacked. So PIRP is made for smaller business MSME. It only apply when the default amount is up to 1 crore. Right, option C. If the default is more than 1 crore, MSME have to go through a longer process, and that longer process is called CIRP. CIRP means Corporate Insolvency Resolution Process, which happen under IBC, Insolvency and Bankruptcy Code. You can think of it like this. If you owe 90 lakh, you can use the faster PIRP, but if you owe 1.5 crore, you have to go for CIRP, and you know CIRP takes more time and is more complex. Let's check other option. 10 lakh, 50 lakh, 10 crore, this is wrong. So what we learned from this question is that PIRP is only for MSME and default is less than 1 crore. For more than 1 crore, use CIRP. So PIRP advantage is it is faster, simpler and cost effective. Now the question is, in PIRP, who primarily initiate the resolution process and file the application? So who initiate PIRP? This is the question. Option A, debtor only. Option B, financial creditor with at least 66% voting. Option C, adjudicating authority. Option D, insolvency professional. So let's you know it very well that PIRP is a debtor in possession model. It means the MSME keeps control of the business, but the actual process start only if the financial creditor approve it. So it is a debtor in possession model, which means the MSME, which means MSME keep control of the business, but the actual process will start only if the financial creditor approve it. So financial creditor must have at least 66% voting right in the favor of starting an PIRP. Let me give you one example. Suppose the MSME want to use PIRP, so it must first talk to its financial creditor. Let's say 3 bank gave loan, but if the bank holding 66% or more of the total loan amount say yes, then the MSME can file PIRP. So again I am repeating that if an MSME want to use PIRP, it must first talk to the financial creditor. Let's say it was funded by 3 banks, and any one bank fund more than 66% of the loan, right? Then if that particular bank say yes, you can go for it, right? You can go for PIRP, then MSME can file the PIRP. So remember, who can initiate the primarily it is initiated by financial creditor with 66% voting. But if no financial creditor are there, the company can pass a special resolution with 75% approval. What about other option? Option number A say debtor only. So debtor can't alone, they need creditor support. Adjudicating authority only approve the plan, they don't start it. The question is regarding who initiate. Initiate means who start. Option D says insolvency professional or IP. So IP handle the process after it is initiated, not before. So IP handle the entire process after the PIRP is initiated, they don't handle it before. So this is also wrong. So correct answer is option B. So what we learned from this question is that PIRP is initiated by financial creditor with 66% voting right. MSME proposes, but creditor must approve it first. If no creditor are there, MSME can use 75% shareholder vote. Now have a look at the third question. This PIRP, last time 5 marks case study was asked based on PIRP. Have a look at the third question. What is the maximum time limit to complete the entire PIRP for MSME? Very good question. What is the time frame within which the entire PIRP for MSME must be completed? 90 days, 120 days, 180 days, 365 days. What is the answer? Please tell me. Maximum time limit. So the whole PIRP must be finished within 120 days from the date it starts, from the date of initiation. That is option number B is correct. Also the resolution plan must be submitted within 90 days. If it is not submitted or approved in time, the PIRP is terminated. So let me give you one example to make it more clear. Let's say day number 1 PIRP start. By day 90 resolution plan must be ready. By day 120 it must be approved. If not done, the PIRP closes, no more chance. So answer is 120 days. Had the question been when plan must be submitted, it should be in 90 days, right? So remember the key point that PIRP must be finished within 120 days. Plan must be submitted within 90 days. It should be approved by 120 days. If you miss the deadline, process end automatically. This is very, very important. Now, full recap. Let's recap the three questions which we have done just now. First of all, PIRP limit maximum default 1 crore. That is the limit. Above 1 crore, PIRP is not there and it is applicable only for MSME. Second point, initiation. So to initiate PIRP, you need 66% vote of the financial creditor. Although it is a debtor in possession model, but it needs 66% vote of the financial creditor. Third point, time limit. It should be completed in 120 days and planned within 90 days. If you really like this easy explanation, don't forget to give a thumbs up. Now friends, have a look at the next question. Which of the following ratio is classified as solvency or leverage ratio? Very good question it is. Right, options are stock turnover ratio, debtor velocity ratio, debt equity ratio, creditor velocity ratio. So what is solvency ratio? A solvency ratio tells us if a business can pay back its long-term loan or not. Suppose a business has taken the loan. If it is able to pay back the long-term loan, that is what solvency ratio tells us. Right, it shows the financial health of the company in the long run. Remember, because the name itself says long-term loan, so obviously it shows the financial health of a business in the long term. In the long term, if you look at the debt equity ratio, which is the correct answer here. So debt equity ratio, what is the definition? What is the formula? In the numerator we write the total borrowed fund. In the denominator we write the equity, which means owner investment. So that is our leverage ratio. That is the solvency ratio. For example, let's say a company has 50 lakh in debt. It has taken 50 lakh, it has borrowed 50 lakh from the bank and rupees 20 lakh in equity. So debt equity ratio will be 50 upon 20, which is 2:1. That means company is using 2 rupee of debt for every 1 rupee of its own money. Remember, higher the solvency ratio, higher the leverage ratio, higher the risk, because more borrowed money means more pressure to repay. Let's see the other option. What about a stock turnover ratio? This is called, activity ratio, not a solvency ratio. This stock turnover ratio tells us how quickly a stock is sold and replaced. For example, if a shop restock every item 5 times in a year, suppose if a shop restock item 5 times in a year, so the stock turnover ratio is 5. This shows inventory efficiency, not loan repayment ability. Here we are more focused on loan repayment ability. What about debtor velocity ratio? Debtor velocity ratio also called activity ratio. So stock turnover ratio also called activity ratio. So debtor velocity ratio shows how fast customer pay their dues to the company. For example, if customer takes 60 days to pay, so the debtor velocity is 60. Useful for managing working capital but not about long-term loan. What about creditor velocity ratio? It measures how quickly the company paid supplier, the company paid its creditor. Right, if the company pay creditor in 45 days, so the creditor velocity is 45 days. Again, this is related to the daily operation, not solvency. So let's summarize the key fact what we have learned here. Remember, debt equity ratio is a kind of solvency ratio. It tells how much debt versus owner money is being used. It shows company long-term financial risk. Whereas stock turnover ratio, debtor velocity ratio, creditor velocity ratio, these are all kinds of activity ratio. They show efficiency, they don't show the solvency. Now have a look at the next question. Okay, this question is based on LC, how many LC to be opened, lead time 10 days, transit time 20 days, treasons period 6 months, monthly consumption of 1 crore, right? EOD, end of day stock of 1 crore. How many LC needs to be opened for the year? So first of all, what you do, you add the lead time, you add the transit time, you add the usance period. This will give you the total time it takes for one LC to complete. So it will be almost 6 plus 1 month, 7 months. So it takes 7 months for one LC to be complete. Okay. Now EOQ, I think a monthly consumption they have given 1 crore, right? So total consumption upon EOD, that is 6 LC to be opened. Now what is the frequency of LC to be opened? The frequency of LC is 12 upon 6, which is 2 months. LC limit, how to calculate the LC limit? Total time, frequency of opening LC, how many outstanding LC at a particular time. So total time it takes 7 months. After every 2 months one LC is getting opened, right? Because we have just calculated the frequency. And once we know the frequency, just divide the total number or total time it takes to the frequency. That will give us 3.5, which is almost equal to 4. So that is the 4 LC, right? 4 LC at one particular time. And what is the outstanding LC? What is the monthly consumption? Monthly consumption is 1 crore. So 4 crore is the limit, right? Now have a look at this particular question regarding ECB, external commercial borrowing. So question is, which of the following statement is not correct as per the ECB guideline? Option A, ECB can be raised up to USD 750 million per financial year under the automatic route by all eligible borrower except a startup, which are capped at USD 3 million. Option B says ECB liability equity ratio of 7:1 is applicable if the foreign currency ECB is raised from a direct foreign equity holder under the automatic route. Option C say ECB proceed can be freely used for issuance of guarantee by Indian Bank and NBFC. Option D says that currency of ECB can be changed freely between freely convertible foreign currency, or even into INR. So these are the 4 options. Please go through it. Pause the video. Tell me which one is correct, which one is not true. That means 3 options are correct, 1 is not true. Now let's go through each and every option. First of all, let's look at option number A. So first of all, let me explain. Most eligible company can borrow up to 750 million US dollar every year from abroad under the automatic route. But under automatic route, no special RBI approval is required. But a startup has a much lower limit, that is only 3 million US dollar. So yes, this option A is true. Option A is saying the same thing, that $750 million ECB can be raised and a startup $3 million. Bilkul, absolutely correct. What about option B? See, option B says that ECB liability equity ratio of 7:1 apply if ECB is raised from foreign equity holder. This means if a foreign investor owns share in an Indian company and also give it a loan, that is ECB, then the total loan amount can be only 7 times the equity they hold. For example, if the foreign equity holder has invested 10 crore in equity, so they can only give loan up to 70 crore in ECB, not more than that. That is called liability equity ratio. Liability means how much loan they can give. Equity means how much equity they have invested. So this ratio protects the company from being overburdened with loan. So this statement is also correct. What about option C? Option C is not correct. Why? Because it said that ECB proceed can be freely used for issuance of guarantee. No. this is not allowed. You cannot use ECB fund for giving guarantee through Indian bank or NBFC. RBI has clearly restricted this. So this is the wrong statement, and therefore this is the correct answer to our question. What about option D? Currency of ECB can be changed freely between freely convertible foreign currency or ever into INR. Yes, this is correct. If a company raise ECB in, say, suppose US dollar, suppose a company raise external commercial borrowing in US dollar, right? So they can later convert into euro, yen, or even Indian rupee, as long as currencies are freely convertible. So as long as the currency are freely convertible, the currency in which ECB was raised earlier, it can be easily be converted into other. So this RBI allow this kind of flexibility. So what we learned from this question, option number A, yes, it is correct. Up to 7, general cap is to $750 million US dollar, and for a startup it is $3 million US dollar. Option B, yes, it is correct. 7:1 ratio between ECB and equity, loan and equity for foreign equity holder. C is not true. ECB cannot be used to issue guarantee, and D is true. ECB currency can be converted into INR or any other freely convertible currency. So this is the complete breakdown of this tricky ECB MCQ. So remember, ECB question is also most frequently asked in the examination. Have a look at the next one. Right, very good question it is. Have a look at it. So the question asks, which of the following correctly match the risk parameter with a description? So there are 3 risk parameter: PD, LED, LGD, EAD. So which is not which correctly match? Option A, PD, it measures how much exposure is lost when a borrower default. LGD, it refers to the likelihood of a borrower failing to meet obligation. EAD, exposure at default, it refers to the gross loan exposure at the time of default. And option number D, PD, probability of default, it measures the amount recovered after the default occur. Again, I am showing you all the 4 options. So these are the 4 options you can see. Please try the question on your own. Now let's start with the first option. So option number A, it says that PD measures how much exposure is lost. This is incorrect, because PD stands for probability of default. It tells us how likely the borrower is to default. Simple example, suppose a borrower has 2% PD, that means 2% chance is that they might not repay the loan. But this option wrongly say that PD is about how much it is lost. No, how much it is lost is about LGD, not PD. What about LGD, loss given default? So LGD means loss given default. It tells us how much of the money we won't be able to recover if the borrower failed. Yes, we know that borrower has failed. So how much money we will not be able to recover. That is called the loss. For example, suppose LGD is 40%, and it means that we will lose 40% of the amount if the default happened. So what PD was telling? PD was telling the probability of default. What is the chance that borrower might not repay the loan? And what is LGD? We know that borrower will default. How much loss we will incur, right? But this question is talking about the probability, which is PD, not LGD. So both options are wrong. What about C, EAD? So EAD means exposure at default. It tells us how much money the bank has at risk at an exact time if the borrower default. Yes, that is called EAD. For example, if a borrower has 10 lakh loan and 2 lakh credit line is used, so EAD is 12 lakh. So this definition is exactly accurate. What about option D? PD measures amount recover after default. So this is a confusion, right? PD is not about how much we can recover. It's all about how likely we will default, right? Recovery always come from LGD, not PD. So let's quickly recap the point which we have just covered. PD means likelihood that borrower will not be able to repay. LGD, which means how much we lose if default happen. EAD, which means exposure at default, means total loan amount exposed at the time of default. So remember PD, LGD and EAD. So easy way to remember is PD means probability of default, LGD means loss after default, EAD means exposure at the time of default. P means probability, L means loss, and EAD means exposure. Just remember it. That's it. Now have a look at this particular question. Right? Have a look at it. So the question says that a project costing 20 lakh, right? A project cost 20 lakh and earn 3 lakh profit per year after charging 10% depreciation before tax at the rate 50%. What is the payback period of this project? This kind of question is asked in the examination. Options are 4.25 year, 5 year, 5.71 year and 6.50 year. Let's understand this step by step. So first of all, project cost is given 20 lakh, profit is given 3 lakh per year, right, after depreciation but before tax. Depreciation is given 10% of 3 lakh, sorry, 10% of the costing, that is 20 lakh, that is 2 lakh per year. Tax rate they have given 50%. Now first of all, what we will do, we will calculate PAT, profit after tax. How to do that? See, we are told that profit before tax is 3 lakh, right, and tax is how much? 50% of 3 lakh, which is how much? 1.5 lakh. So PAT means profit after tax will be 1.5 lakh, isn't it? So let me show you the calculation. right? So PBT is 3 lakh, tax is 50,000, tax is 1,50,000, so PAT is 1,50,000. Now add back the depreciation to get the cash inflow. Remember, this is a very crucial step, that we need to add back the depreciation. And what is depreciation? 10% of 20 lakh, which is 2 lakh. So 2 lakh we add back to PAT. So this will give us how much? This will give us 3.5 lakh. Now what is the payback period? Payback period means initial investment upon annual cash flow. So annual cash flow we have is 3.5 lakh and the initial investment was 20 lakh. So if we divide both of them, we will get 5.71 year. So let's see the option that we have. Yes, 5.71 year is the correct answer. So remember, payback period tells us how much time it takes to recover the initial investment that we made. That's why we divide the initial investment with respect to the cash inflow. That means cash inflow is the yearly cash that we are getting, right? And we have invested some amount. So how much time it will take for all the cash inflow to generate equal amount to get equal to the total investment? It will take 5.71 year. So remember, what we learned from this discussion is that depreciation. So one question you may ask me, why we have added the depreciation to the PAT? Remember, the rule is that depreciation is a kind of non-cash expense. We will add it back while calculating the cash flow. And you must remember the payback period formula: total investment upon divided by annual cash flow. Always calculate PAT, then add depreciation to find the real cash flow. Remember it. Don't take PBT, right? Now have a look at the next question. So the next question is regarding large exposure framework, LEF. Under RBI LEF, which of the following entities is not subject to LEF norm? So options are a scheduled commercial bank, urban cooperative bank, and foreign bank, and NBFC. Actually, this question is partially wrong, because NBFC with respect to the earlier syllabus, NBFC was the correct answer. But with respect to the recent amendment which is done by RBI, NBFC upper layer has also been included under the larger exposure framework. So completely we can't say that D is the correct answer. So let's skip this particular question. Now have a look at the next one. Yes, margin of safety calculation, very important calculation. How to go about calculating the margin of safety? Selling price per unit rupees 10, variable cost per unit rupees 6, fixed cost 40,000, actual sale 80,000. What is the margin of safety? So before calculating the margin of safety, you need to calculate the break-even point. And how to calculate the break-even point? I think we have discussed. What we need to do? We need to divide the fixed cost with respect to the contribution per unit. And what is contribution per unit? Selling price minus variable cost. So selling price is 10 rupees, variable cost is 6 rupees. So contribution will be 4 rupees per unit. And what is the fixed cost? That is 40,000. 40,000 divided by 4 rupees, that will give you 10,000, isn't it? So 10,000 is the break-even point. 10,000 unit is the break-even point. And what is the actual sale? Just wait a minute, let me show you the calculation. Right, so sorry, break even, yes, 10,000. And in terms of unit, if we do, so 10,000 units, in terms of value if we do, so one item cost how much? One item cost how much? Selling price is 10 per rupees. Sorry, 6 rupees. 6 rupees is the cost price, I think. Variable cost, right? So just multiply this 10,000 with 10, that will give you, I think there is a mistake here, calculation mistake here. Right, there is a calculation mistake. Please, let's correct it. 10,000 multiplied by 10 will be 1 lakh. And margin of safety is the actual sale minus break-even sale. Right, which will be how much? I think actual sale is 80,000 and break-even sale is 1 lakh. So 20,000. I think there is a mistake here. So margin of safety indicate how much sale can drop before the firm reaches break-even. A higher margin means a strong cushion against the loss. Now, which of the following statement is not regarding the DDA is not true? Diamond dollar account is not true. That is the question. Option A, firm dealing in cut and polished diamond can operate through DDA. Option B, a firm must have a minimum 1 year track record in diamond trade to open a DDA. Option C, minimum average annual turnover of 5 crore is required over the last 3 licensing year. Option D, Antwerp is known as the diamond capital of the world and is located in Belgium, which is not correct. That is the question. Let's understand what DDA is. DDA stands for Diamond Dollar Account. It is a special type of account in foreign currency. It is mainly for firms that import, that export diamond and diamond studded jewelry. It helps this business avoid currency conversion loss and make international trade easier. Let's check each option one by one. First of all, option number A, firm dealing in cut and polished diamond can operate through DDA. Yes, it is true. In fact, not only cut and polished diamond, even firm dealing in rough diamond or diamond studded jewelry, they are also eligible. For example, if your company export diamond ring to the US, you can use a DDA to handle payment in dollar. What about option B? Option B says a firm must have minimum 1 year track record. No, that is why this is the correct answer. This is the wrong answer, and this is the correct answer as per this question, because not true is asked. The rule is, if a firm have at least 3 years of experience in importing and exporting diamond, then only you can open DDA account. So if you have been in the diamond business for just 1 year, you are not eligible. What about option C, minimum average turnover? So this is true. To qualify for DDA, your diamond trading business must have an average turnover of 5 crore or more, and this amount only serious and established player get access. What about option D, Antwerp? Antwerp is known as the diamond capital of the world. So Antwerp, it is a globally very famous. So yes, it is the correct answer. It is very famous for diamond trading market. It is called the Dalal Street of the diamond world. So let's summarize the key point which we have just discussed now. First of all, firm dealing in diamond or diamond jewelry can open DDA. Minimum 5 crore turnover over the last 3 years is needed. And Antwerp is a Belgium. In Belgium is the world diamond hub. Just remember it. Now, which of the following is the key characteristics of the commercial paper in India? Commercial paper key characteristics. Option A, CP is always backed by collateral to ensure repayment. Option B, only company with a net worth of at least 5 crore and a strong dividend payment record can issue CP. Option C, the minimum size of a single CP issue is 10 lakh. Option D, CP must always be issued at face value with no discounting allowed. Tell me, which one is the key characteristics? Very good question it is. So before diving into the question, let's understand the basic. So first of all, option A, that CP is always backed by collateral. No, this is wrong, because CP is an unsecured money market instrument. That means no collateral is needed, and it depends on the credit worthiness of the company. You can think of it like the top rated company saying, today trust me, I will repay in few months without offering security. Option B say that this is based on Vagul committee. Remember the name of committee, Vagul committee recommendation. And the Vagul committee recommendation says that to issue an CP, a company minimum net worth is 5 crore. Option B, that it should have a good dividend income, record business. And finally, for example, a reputed manufacturing firm with 10 crores net worth and 3 year of regular dividend payout can issue commercial paper. What about option C? Minimum size of single CP issue is 10 lakh. So commercial paper, tell me, what are the condition must a company meet to issue commercial paper in India? Option A, it must have a debt ratio exceeding 1.5 and current ratio below 1. Option B, the company must be listed on a stock exchange and maintain a minimum net worth of 5 crore. Option C, the company must provide bank guarantee to back the CP issuance. Option D, the CP must be issued only in physical form with a stamp duty applied. Chaliye, let's go through each and every option. Option number A, in option number A, you can see debt ratio should not exceed 1.05, but here it is written 1.5, so this is wrong, right? Or current ratio should be at least 1.33, right? So both our options are wrong. So financial statement should be strong. If your debt are too high or liquidity is too low, you are not allowed to issue CP. Second point, option number B. So it says that company must be listed on stock exchange. So it must be listed on a stock exchange and it must have a minimum net worth of 5 crore. So yes, this is the correct answer. So this ensure only a stable company can issue CP in the market. Option number C, the company must provide bank guarantee to back the CP issuance. This is incorrect. CP is not backed by bank guarantee. It is unsecured, no guarantee, no security, only a strong reputation. Option D, CP must be issued only in physical form with a stamp duty applied. This is wrong, because CP is mostly issued in demat form, just like share. And the good news is that it is exempted from stamp duty, so no extra cost here. So let's quickly recap the key points. First of all, commercial paper is an unsecured short-term instrument. It is for company with 5 crore plus net worth and good financial record. Minimum A3 rating. It is issued at discount or with interest. Minimum size is 1 crore. Issued in demat form, no collateral, no stamp duty. So that was everything you need to know about commercial paper, made easy for exam and interviews. Now have a look at this small and marginal farmer. So the question is, which of the following category is included under the definition of small and marginal farmer for priority sector lending sub-target? So definition of SMF, that is what have been asked. Option A, farmer with land holding above 2 hectare but below 5 hectare. Option B, tenant farmer and sharecropper with land holding share within 1 hectare, or 1 to 2 hectare for small, 1 hectare for marginal, 1 to 2 hectare for small. Agriculture corporation with more than 50% non-farmer shareholder. Option D, loan exceeding 5 lakh to individual engaged in allied activity without land holding criteria. So tell me, which of the following categories included under the definition of small and marginal farmer? So let's look at the option number A. So this is the common confusion. Farmer with land above 2 hectare are not SMF, right? So a small and is marginal, is marginal means up to 1 hectare. Small means more than 1 hectare up to 2 hectare. So anyone with more than 2 hectare fall outside this category. Small means less than up to 1 hectare. Up to 1 hectare, marginal. Small means 1 hectare to 2 hectare. That is called small. Right. What about option B? Option B, tenant farmer. Yes, even if someone is not the landowner, for example a tenant farmer or a sharecropper, as long as they cultivate land within the SMF limit up to 2 hectare, they are included under SMF for lending purpose. For example, a landless farmer working on 0.8 hectare as tenant, they are considered marginal farmer. A sharecropper managing 1.5 hectare, they are considered a small farmer. Now option C, agriculture corporation with more than 50% non-farmer shareholding. So agriculture corporation, or company with majority of non-farm shareholder do not qualify. SMF is meant for individual or small group directly involved in farming or allied activity, not big commercial entity. So this is the case of big commercial entity. No, SMF is not given to them, right? So agriculture corporation or company with majority of non-farming shareholder do not qualify. What about option D? Loan exceeding 5 lakh to individual engaged in allied activity. So loan for allied activity like dairy, poultry or fisheries can be included, but only if the loan is up to 2 lakh and the borrower fit into the small and marginal category, right? So loan is up to 2 lakh only, but here the loan is given 5 lakh. So they are not land, and there is no land holding check. So that will not be considered as SMF. So remember, quick recap, what is SMF? Let's quickly recap it. First of all, marginal farmer is one who owns or work up to 1 hectare. A small farmer is one who owns or work up to 1 to 2 hectare. It includes tenant farmer, sharecropper, landless labor. It helps bank meet priority sector lending sub target. And what it exclude? It exclude farmer with more than 2 hectare. It exclude corporate or large firm. It exclude high ticket loan like over 5 lakh without proper land holding. So understanding who qualified as a small and marginal farmer is very, very important for CCP examination. Last time question was asked. Now have a look at this particular question. So the question is asking you, which of the following statement best describe the significant and limitation of RAROC? You know what is RAROC? Risk adjusted return on capital. So which describe the significance and limitation of RAROC? Option A, RAROC eliminate the need for other financial metric like ROE. Option B, RAROC help institution allocate capital efficiently but depend on assumptions and data, right? And option C, that RAROC is mostly used for non-financial firm. Option D, RAROC is simple and does not require much data or modeling. So RAROC stands for risk adjusted return on capital. First of all, let's look at option A. So this says that RAROC replaces metric like ROE. Yes, this is not true, right? RAROC is not a replacement but a complementary tool. You can think of it like this. ROE tells you how much return you get on shareholder equity, that is called return on equity. But RAROC tells you that how much return you are getting compared to the risk taken. You need both to make a smart financial decision. What about option B? Option B is also correct, because RAROC is used by bank or financial institution to compare profit with the risk involved in lending and investment. It helps in capital allocation, meaning where should the bank invest in money to get maximum return with minimum risk. But here is the catch. It is only as good as the data and the risk model used. If your assumptions are wrong, RAROC will give misleading result. For example, a bank is deciding between two loan proposals. One is very high risk or with high return, and the other is low risk with moderate return. So RAROC helps them choose which one is worth the risk. What about option C? Option C says that RAROC is used by non-financial firm. This is wrong, because RAROC is mainly used by bank, investment firm and other financial institution because they deal with credit risk, market risk and operational risk. What about option D? So RAROC is simple and does not need much data. That is a myth. RAROC is actually complex. It needs accurate measurement of expected loss, capital at risk, risk weighted, right, market and credit data. So a small firm without access to good data might find it hard to use RAROC effectively. So let's let's quickly summarize what we learned. RAROC stands for risk adjusted return on capital. It compares return versus risk. Why it is useful? Because it helps bank decide where to invest money. It support capital allocation. It add a risk perspective to profitability. And the limitation is that they need good data. They rely on accurate risk model, and they should be used with other metric like ROE. So the next time you hear about a bank choosing between investment, remember it is not just about return. It's about return with risk. That is what RAROC help them measure. So friends, that is all we need to learn from this particular chapter. That is all from which were asked. We have more questions set. If you want me to explain more, just write yes in the comment section. I will bring the part 2 lecture of this particular video. Right. So these are all recollected questions which has been given by the students who have appeared in the examination. If you also appear in the examination and want to share question, please see the WhatsApp number below, and you can directly WhatsApp me on this particular number with the question.
Question is, a company sell a product at 8 rupees per unit. The variable cost per unit is rupees 5 and the fixed cost are rupees 180. What is the break-even point in terms of units? Options are 22.5 unit, 30 units, 60 units, 90 units, etc. So friends, what does break-even point means? So basically it is the number of unit a company need to sell to cover all cost. So to cover all cost, what are the basically number of unit that needs to be So to cover all the cost, the number of units that needs to the company need to sell, that is called break-even point. So at the break-even point, no profit, neither any profit, nor any loss. Right? Let's find the correct answer. So I think you know the formula for calculating the break-even point. What is the formula? It is nothing but fixed cost. In the numerator we write the fixed cost. In the denominator we write selling price minus variable cost. Right. So now in this particular case, as you can see, what is our variable cost? VC is how much? VC is 5 rupees. Right. What is our fixed cost? FC is how much? Rupees 180. And finally, the selling price is SP is how much? 8 rupees. Right. So friends, just first of all, find the contribution per unit. First of all, find the contribution per unit. What will be the contribution per unit? It will be nothing but selling price minus variable cost. What is selling price? 8 rupees. What is variable cost? 5 rupees. So 3 rupees is your contribution per unit. Now what we need to do? We need to divide the fixed cost by the contribution. So fixed cost is to be divided by contribution. So fixed cost is 180 rupees. Right. Fixed cost is 180 rupees and contribution is 3 rupees. So if we divide both of them, we will get 60 units. So the company need to sell 60 units to break even. Now let's analyze each and every option. Option A says 22.5 unit. So if mistakenly someone divide fixed cost by selling price, he will get 22.5 unit. But this is the wrong, because we have ignored the variable cost. You can't ignore cost, right? What about 30 unit? 30 unit is also wrong, right? And the correct answer is 60 unit. Option number C is the correct one. Right. So for example, suppose you run a lemonade stand. Selling price is 8 rupees per glass. Cost per glass is rupees 5. Fixed cost is rupees 180. So basically you are earning 3 rupees per glass. To recover rupees 180 as rent, how many glass you have to sell? So that is nothing but 180 divided by 3, which means 60 glass. That is your break even. So remember, what we learned from this question is that, first point is that at the point of break even, at the point of break even, no profit, no loss. Just remember, no profit, no loss. What is the formula? The formula is, fixed cost divided by selling price minus variable cost. That is the formula. And as per this question, the correct answer is option number C, which is 60 units. Now friends, let's have a question on calculation of profitability index. This is the most frequently asked question in the CCP examination. Let's have a look at it. So friends, this is the most useful tool to check if the investment is worth it. So we will go through each and every option, understand why some are wrong and find the correct answer. So the question are the 3 projects having the following discounted cash inflow. So discounted cash inflow has been given in one column. Initial investment has been given in the another column. Right. So 3 projects with cash inflow they have given you. And discounted cash inflow for project A is 8,40,000. and initial investment is 7 lakh. For B it is 2 lakh 10,000. Initial investment is 1 lakh 90,000. For C it is 5 lakh. Initial investment is 5 lakh 20,000. Now the option, so question is, which project are profitable based on PI and what is the PI for project A? So option A says that both A and B are profitable and PI for project A is 1.20. Option B says that both A and C are profitable and PI for project A is 0.83. Option C says both A and B are profitable, PI for project A is 0.83. And option D say all projects are profitable and PI for project A is 1.20. So first of all, let's understand what is the profitability index. What is the meaning of this PI? So basically, it is a ratio that tells us how much profit we get for every rupee invested. Simply it tells you how much profit you get for every 1 rupee that you invest. For every 1 rupee that you invest, how much profit you get. That is what is told by the profitability index. Now the formula for PI is very simple. Formula for PI is very simple. We write discounted cash inflow in the numerator. Discounted cash inflow in the numerator, and in the denominator we write our initial investment. Because we have to know that how much profit we are getting for every rupee invested. So now two things can happen. PI can be less than 1 or PI can be greater than 1. If PI is less than 1, it means project is not profitable. PI is less than 1 means project is not profitable. And if PI exceed 1, it simply means project is profitable. Right? So means project is not profitable means what? Earning more than the cost. Project is profitable means what? Sorry, profitable means earning more than cost. Not profitable means cost more than earning. Now let's calculate the PI for each and every project. So first of all, let's see for project A. For project A, what is the discounted cash inflow? 8,40,000. What is the investment? 7 lakh. So 8,40,000 divided by 7 lakh. So this will give you 1.20. This is the PI for project A. Now let's move to the project number B. For project number B, 2,10,000 is your discounted cash flow and initial investment is 1,90,000. So if you divide both of them, you will get how much? You will get 1.11. So for project B, PI is 1.11. For project C, cash inflow is 5 lakh, right? And initial investment is 5,20,000. So if you divide both of them, you will get 0.96. So friends, if we can say that for project C it is 0.96, since it is less than 1, so it is not profitable. Now let's analyze each and every option. Option A say project A and B are profitable and PI for project A is 1.20. Yes, correct. It matches our calculation. Exactly, correct. B say project A and C are profitable and PI for project A is 0.83. That is wrong. C is not profitable because for C, we are clearly observing that PI is less than 1. And we know that PI is less than 1, it means not profitable. For option C, A and B are profitable and PI for project A is 0.83. That is also wrong. And option D, all projects are profitable. Right. PI for A is 1.20. That is also wrong. C is not profitable. Right. So let me give you a real life example to make it more clear. Imagine you are investing in 3 small business. So business A, you invest 7 lakh and earn back 8.4 lakh. So what is your PI? Your PI is 1.20. That is your business A. In business B, you invest 1.9 lakh and you earn 2.1 lakh. So what is your PI? Your PI is 1.11. So this 1.20 is great. This 1.11, it is good. Then look at the business number C. You invest 5.2 lakh and you get 5 lakh as return. So your PI is just 0.96. This is a loss, right? So the moral is that always check PI before investing. So remember what we just learned from this particular question. This formula you need to remember. That is sum of the discounted cash inflow upon initial investment. This gives us the PI. And two things are there. If PI is greater than 1, it means project is profitable. If PI is less than 1, it means project is not profitable, right? So that is the point. Friends, if you are looking for such kind of previous year memory based question, unit-wise theory, unit-wise MCQs as per the syllabus prescribed by IIBF, you can enroll in our CCP course, which only costs ₹200 for the entire content. And many aspirants have cleared the examination successfully since this particular February examination. I will provide you some testimonial. So if you want to get access to such kind of premium material, you can WhatsApp me on this particular number or you can check the course description section In the description section of the video, I provided you the link of the course. So you can do either of them to get access to our premium material on the certified credit professional examination. Now friends, let's see the question number 3. Again a very good question which was asked in the June 20th examination based on payback method. So this is also a numerical based question. That's why I told you should have a pen and paper with you. Now let's see what this question is all about. So basically ABC Limited is evaluating a project with the following annual cash inflow. So as you can see, year 1 annual cash inflow cumulative. So cumulative, how to calculate. Just put this 80,000 here. Year 2 cash inflow is 60,000. So add 80 plus 60, this will give you 1,40,000. Then year 3 it is 60,000. Add 140 to 60, this will give you 2 lakh. Then year 4 it is 20,000. Add 2 lakh to 20,000, this will give you 2,20,000. So we have a table in which on one column we have the year, on second column we have the annual cash inflow, on the third column we have the cumulative cash inflow. Now the question is, if the initial cash outlay is 2,07,500, what is the payback period? Very good question. And 4 options has been given. I request you to please pause the video here. First try the question yourself. Now first of all, let's understand what is the meaning of this payback period. So payback period simply means, the time it takes to recover your investment. To recover your investment. How much time it will take to recover your investment? That is called payback period. Now the question is how to calculate this payback period. So basically what you need to do, you need to keep adding. You need to keep adding up the cash inflow. You need to keep adding up the cash inflow year by year. Right? You add up the cash inflow year by year until you reach the initial investment amount. If it does not recover fully in a whole year, we calculate what fraction of the next year cash flow is needed to fully recover the amount. So let me give you one example. Let's calculate it step by step. First of all, let's see the calculation of the cumulative cash inflow. So after we see this column will not be given in the question. They will just give you the annual cash inflow. That's it. Cumulative cash inflow you have to calculate. How to go about calculating cumulative cash inflow? So for year 1 it is just 80,000. For year 2 it is 80,000 plus 60,000. It is equal to 1,40,000. I am telling you now, cumulative cash inflow they will not provide you. Right? You have to calculate it yourself. Just now I am telling you how to do that. Now, if you want to calculate after year 3, so what will that be? 1,40,000 plus 60,000. This will be 2 lakh. That you can see here. And for after year 4, it will be 2 lakh plus 20,000, which will be 2,20,000. So our initial investment was how much? 2,07,500. By the end of year 3, you see, by the end of year 3, we recovered rupees 2 lakh. So we are still short by how much? Tell me. So by the end of year 3, we have recovered 2 lakh rupees and we are still short by how much? 2,07,500 minus 2 lakh. So what would that be? That would be 7,500. So we are short by this much amount, 7,500. Now let's calculate the fractional year. Right. So let's calculate here the fractional year. Let me do the calculation for you. Fractional year. So basically in the year 4, how much profit we get? In the year 4, the cash inflow is 20,000. But we only need 7,500 more to fully recover our investment. So what portion of year 4 do we need to get that 7,500? See, it is very simple. Quite simple. You can easily understand it. See, in 1 year, tell me. Right. So basically we are interested to know what portion of the year 4 do we need to get that 7,500. So just write in the numerator amount left. In the numerator, you write the amount left, and in the denominator, you write the year 4 cash inflow. Year 4 cash inflow. That's it. So what is the amount left? That is 7,500. And what is the year 4 cash inflow? Which is 20,000. Just divide both of them. You will get 0.375 year. So this 0.375 year. So the total payback, we have to calculate the total payback, right? The total payback will be how much? 3 years plus 0.375 year, which is equal to 3.375 year. Right? That is our answer. So let's see the option that we particular question. The first point that we learn is that, first of all, what is the meaning of payback period? I told you, payback period just means that what is the time taken to recover the initial investment. The time taken to recover the initial investment is called the payback period. So remember, whenever payback period calculation is asked, what you need to do? you need to calculate the cumulative cash flow, right? You need to calculate the cumulative cash flow year by year, right? And also you need to add fractional year. Yes, you need to add fractional year if needed. Yes, you need to add fractional year if needed. So here the closest answer is 3.38 year. Now friends, let's come to the next question, and this question is based on net present value calculation. Very important from examination point of view. Let's have a look at it. So the question says that a project requires initial investment of 1 lakh. As you can see, initial investment is 1 lakh rupees. The expected net cash flow for our 3 years. What are the net cash inflow for 3 years? As you can see, 55,000, 80,000 and 15,000 respectively. And the company cost of capital is 10%. Present value interest factor for year 1, year 2, year 3 are 10%. At 10% rate are 0.909, 0.826 and 0.751 respectively. What is the net present value of the project? See, the PVIF, you know what is the meaning of PVIF? Let me explain. So basically, there is a formula that is called 1 by 1 plus r whole to the power n. See, if you put n is equal to 1 and r is equal to 10%, which is 0.1, so you will get 1 by 1.01, right? 1 by 1.1, right? So the value of 1 by 1.1 will be how much? 0.909. Similarly, 1 by 1.1 ka square, the value will be 0.826. Similarly, 1 by 1.1 ka cube, the value will be 0.751. So that is the meaning of it, right? So friends, what we have just discussed is that, so this is how we calculate the present value interest factor. Okay. So the company cost of capital, they have given 10%, and cash inflow they have given over 3 years, right? Present value interest factor for 3 years they have given. Now the question is, what is the net present value of the project? Very good question. So first of all, let's understand what is the meaning of this net present value. See, net present value tells us whether a project will make money after considering the time value of money. Yes, whether it will make money, whether the project will make money after considering the time value of money, that is called TVM, right? So meaning rupees 100 today is worth more than rupees 100 next year. Obviously, if you have 100 rupees today, after 1 year, that 100 rupees is not that much worth. Now the question is how to calculate net present value. So the steps are here. What we need to do? We need to discount future cash inflow, right? We need to discount future cash inflow to their present value, right? And we need to subtract the initial investment. We need to subtract the initial investment, right? So that is what we need to do. Now, two things are possible. First of all, we will discount the future cash inflow to calculate their present value, and we need to subtract the initial investment. Now, two things can be possible. So NPV is greater than 0, it means project is profitable. NPV is less than 0, it means project is not worth it. Right. Now let's calculate the present value of the cash inflow. So 3 cash inflow have been given to us. Let's calculate their present value. So first of all, year 1. Basically the best way to calculate is using the table, but let's calculate it randomly. So year 1. So what is the year 1? 55,000 is the future cash inflow. And to calculate the present value, what we need to do? We need to multiply the future value with the PVIF, which is the present value interest factor. So for year 1, the present value will be future value, which is 55,000 multiplied by PVIF for year 1. What is PVIF for year 1? 0.909. Just multiply it. So 0.909. This will give us 49,995. It means you can think of rupees 55,000 next year is worth rupees 49,995 rupees today. Then let's go to year 2. So for year 2, if we calculate the present value, so what is the cash inflow we have? 80,000. And what is PVIF for year 2? 0.826. So the present value will be 80,000 multiplied by 0.826. So this will give us, 66,080. So that means, 80,000 in 2 years is worth rupees 66,080 rupees today. Now do the similar calculation for year 3. For year 3, the cash inflow we have is 15,000 rupees and PVIF is 0.751. So to calculate the present value, we need to multiply 15,000 with 0.751. So this will give us, this will give us 11,265. Right. Now we have calculated the present value for all the 3 years. As you can see, for first year it is 49,995. For second year it is 63,080. For third year it is 11,265. Now we need to add all of these. So let's add all of these. 49,995 plus 66,080 rupees plus 11,265. After addition, this will give us 1,27,340. So that is the present value of the future cash inflow. This is the present value. Now we have to calculate the NPV. What I told you, after discounting, after calculating the future cash inflow, we have to subtract the initial investment, right? So what is the initial investment here? So the initial investment is 1 lakh. Initial investment is how much? 1 lakh. So just subtract 1,27,340 minus 1 lakh. How much will that would be? That will be 27,340, right? So 27,340 is our correct answer. That is the net present value of the project. And since it is positive, it means our project is profitable. It is worth taking. So option number A is the correct answer, right? So imagine you are investing in a small business. You invest 1 lakh today. Over 3 years, you earn 55,000, 88,000, 80,000 and 15,000. But because of inflation, future money is worthless. So the net present value help you see the real profit in today's money. Here you are actually gaining 27,340 rupees, right, in today's value. So it is a good deal, right? So common mistake that you need to avoid while calculating NPV. Remember, first of all, first thing is that forgetting to discount future cash flow. This is the first mistake. Second mistake is using wrong discount factor. And the third mistake is ignoring the initial investment. So let's summarize what we have just covered. So I told you NPV is simply, remember this formula. Sum of this is no summation. Sum of discounted cash inflow minus initial investment. Then we talk about, discount factor, right? So what is the meaning of discount factor? It adjusts discount factor. What they do? They adjust future money to the present value. And then I told you, if the NPV is positive, it means, project is good. Positive NPV means, project is good, right? So that is the point. Now friends, let's look at one more important question related to the letter of credit which were asked. Friends, if you really think that this particular video is worth knowledgeable, it helps you clear your concept, please hit that like button. This will encourage me to make more such and such content. Please let me know. If you want such kind of videos, please write yes in the comment section. I will provide you more such practical based questions for practice. Now friends, have a look at this particular question. So here is the scenario. There is a company that buy goods worth 6 crore, right? Basically the company buys 6 crore worth of good yearly. And they order in chunk. What is the chunk? They order in the chunk of rupees 1 crore each time. And that is called, economic order quantity, or we call it EOQ. Means per time, one time they order for 1 crore rupees. Now, delivery takes 10 days for lead time, plus 20 days for transit time, plus usance period, which is 6 months. Right? And sorry. So basically, if we talk about the delivery time, it includes the lead time, which is 10 days. It includes the transit time, which is 20 days. So total it is 30 days. So the delivery time is 30 days. Plus, usance period. What is the meaning of usance period? So that is called, 6 month credit. So usance period is 6 month credit. Supplier gives 6 month credit. So basically what we need to find? We need to find that how many LC are active at any time. First question. Second question is what total LC limit is needed. This is the most frequently asked question in the examination. So let's understand each and every part of it. First of all, let's understand the total LC duration. See, first of all, let's go step by step. First of all, let's calculate the total LC duration. So total LC duration is how much? Let's have a look. So as you can see, 1 month is the duration, which includes ordering plus shipping. As you can see, this 10 days is the lead time, which means it takes order to complete, and transit time is, shipping time. So total it is 1 month, and plus 6 months. 6 months, that is the credit period. That is the credit period. So totally we have 7 months. So 7 month total per LC. That is the total LC duration. Right? Very easy to understand. 10 day plus 20 day plus 6 months, which is equal to 7 months. That means, right? So now this is the step number one. Step number one is to compute that total LC remain outstanding. Total LC remain outstanding for 7 months. I hope that makes sense. Step number two is to calculate the order frequency. What is the meaning of order frequency? See, basically 6 crore rupees per year, as you can see here. Basically, they consume good worth rupees 6 crore per year. So, try to understand, this is the very important concept. Try to understand it. What I am telling you, that 6 crore rupees per year. It means, 1 crore rupees per order. Right? Basically, 6 crore rupees per year and divided by 1 crore rupees per order. Because, one order they are giving for 1 crore. And total 6 crore rupees per year. So, how many orders have they given in a year? Obviously, 6 orders they have given. Very easy to understand. Total 6 crore rupees worth order they have given in a year, and per order 1 crore they are giving. So obviously they have given 6 order in that particular year. So obviously we can say that in 1 year they have given 6 order, isn't it? In 1 year they have given 6 order. Now we know that in 1 year they have given 6 order. Now we want to calculate the frequency, which means how often they are giving the order. Tell me, how many months are in their 1 year? Obviously 12 months. So 12 months, 6 order they give. So basically the frequency of giving order is every 2 months, isn't it? So that is what we are interested in, calculating the frequency. So frequency is how much? 2 months. That means 1 order every 2 months, right? 12 divided by 6. Now the third step is active LC at once time. How many LC were active, right? How many are active LC with outstanding LC? So each LC live for 7 months. Each LC live for 7 months and new one comes every 2 months. New one comes every 2 months. So 7 divided by 2, which is equal to 3.5. And if you round off, it will be 4 LC. Because 3.5 LC cannot be in fraction, right? So we need to round it off. So that is equal to 4 LC. So you can't have half an LC, right? That is why, 4 LC are active at a particular time. Now, LC limit. See, 4 active LCs are there. How many active LC are there? 4 active LC are there. And per LC, 1 crore amount. So 4 crore is the limit. 4 crore is the limit. I hope that makes sense to you. Like 4 crore is the total limit. So 4 active LC are there, and per LC, 1 crore amount. EOQ, as you can see, economic order quantity means, 1 LC they are ordering 1 crore rupee. So obviously 4 crore is the limit. So now let's see the option that we have. Option A suggests that 2 LC. No, it is wrong. Option B suggests 3 LC. Wrong. 6 LC. Wrong. 4 LC. Yes. Option C is the correct one. So you can think of it like this. I'm giving you a real life example to make it more clear. Imagine that your kirana store, you order 6 month stock yearly in monthly batch. Each order take 1 month to arrive and 3 month credit. So you have 2 to 3 order active at once. Same logic apply here. So what we learned from this particular question, let me just remind you. I told you now that first of all you calculate the LC duration. First thing is to do is to calculate the LC duration. Right. After calculating the LC duration, you need to calculate the order frequency. After calculating how to calculate the order frequency, see, it is very simple. Yearly demand. Divide the yearly demand by the EOQ. That will give you the order frequency. And how to calculate the total LC duration? Basically, order till payment. How much time it takes from order till payment? That is how we calculate LC duration. And after calculating LC duration, you need to calculate the order frequency. How to go about calculating it? Just divide the yearly demand with EOQ. And then divide duration. Divide duration by frequency. Right. Divide duration by frequency. That will be the number of LC outstanding. And just round it off. And multiply by the order amount to get total limit. So this is the step-by-step procedure. First of all, calculate the LC duration. How to calculate the LC duration? You see how much time it takes from an order till it payment. Then you calculate the order frequency. How to go about calculating frequency? Yearly demand by EOQ. And then you divide the duration with frequency. This will give you the number of LC outstanding at a particular time. Once you know the number of LC outstanding, just multiply it with the EOQ. That is the economic order quantity to get the LC limit. I hope that makes sense to you. Now friends, let's see one more question based on what we have discussed. So the question is, according to the RBI Master Circular on Guarantees and Co-Acceptance, what is the maximum tenure a bank guarantee should normally have? Unless the bank board specifically approve a longer duration. 5 year, 7 year, 10 year, no prescribed limit. See, bank guarantee are like, promissory note. They are like, P notes, where bank promise to pay if a borrower default. RBI set rule to keep this system safe. So first of all, what does RBI Master Circular say? Right. Normally, maximum tenure, for bank guarantee is 10 years. Right. But beyond 10 years, it is possible, but they require, board approval. Yes, beyond 10 years, it is possible, but for that, board approval is required. And then ALM check is also required. What is ALM check? Asset liability management check. Right. Just like you would not lend your bike to a friend indefinitely. Similarly, bank need limits to manage the risk. So that's why option number C is the correct answer. So basically, no bank guarantee should normally have a maturity of more than 10 years. Friends, as you can see, we have more questions available in our this particular session. If you want me to continue, please write yes in the comment section. I will provide you the part 2 lecture of this session also. I hope this session was useful. Before ending of the lecture, let me summarize what we have gone through, what we have discussed. Just summary of the session. This is very, very useful for remembering till the long term. First question I told you, for calculating the break-even point, I told you, break-even point is a point at which neither profit nor loss. I told you what is the formula. Just divide the fixed cost with the selling price minus variable cost. Right. This is how we calculate the break-even point. In question number 2, what we did, we calculated the profitability index. I told you profitability index just means what, that basically there is a formula for calculating the profitability index. It is what? Discounted cash inflow divided by the initial investment. And if PI is greater than 1, it means profitable project. PI is less than 1, it means, loss project. So always go for PI greater than 1 project. Then in the third question, we discuss, payback period calculation. What I told you about payback period, let me remind you. So I told you, that, payback period is what? What is payback period? So payback period means time taken to recover our initial investment. So how to go about calculating payback period? So prepare a table. First of all, compute this cumulative cash inflow, right? And then add fractional year if needed. And then after adding this cumulative cash inflow to the fractional year, you will get the entire payback period. In the question number 4, we talked about, calculating the net present value. How to go about calculating net present value? I told you there is a simple rule to go to calculate that. So what you need to do, first of all, NPV just means, sum of discounted cash flow. Whatever future cash inflow you have, you just discount it to the present value using the present value interest factor. After discounting, you add all of them and you subtract the initial investment from the discounted cash flow. Then you will get NPV. And remember, net present value should be greater than 1. Should be positive. So positive NPV indicates that our project is very good, right? Then in the next question, what we discussed about EOQ, right? That is called economic order quantity. What I told you about EOQ, just remember the step-by-step procedure that we have gone through, right? I told you, first of all, you calculate the total LC duration. How to go about calculating total LC duration? Basically, it is the time from the order till the payment. You add the transit time, you add the lead time, and you also add the usance period to get the total LC duration. Once you have the total LC duration, you calculate the order frequency. How to go about calculating order frequency? It is very simple. Just divide the yearly demand with the EOQ, right? How much yearly demand is there and how much is the economic order quantity? That will give you the order frequency, means how frequently we are ordering. Once you know the order frequency, divide duration by that. So you have calculated the duration, you have calculated the frequency, divide both of them, right? That will give you the number of LC outstanding at a particular time. Once you know the number of LC outstanding at a particular time, just multiply with that EOQ. That means, limit, right? Order amount, that will give you the LC limit. And the last question we discussed about, bank guarantee, maximum limit of time. So what I told you about, that imagine that you are building a highway. So you need a 15-year guarantee for contract payment. So bank can issue this guarantee only if their board approve it and they ensure fund will be available after 10+ years. So remember, by default, maximum time for a bank guarantee is 10 years. For that, no approval is required. If it is beyond 10 years, then bank board must say yes, plus ALM check must be done. RBI rule is like